additional explanation of any kind, so welcome. So it's going to be recorded. And so as president of UNIDROIT, I think this is really the only thing I want to say. I'm proud of the kind of work that is done here, the work that was done in the previous days for those who were in the working group, and really appreciate all the efforts that you are doing and helping us. But I would like to devote a bit more time on Alberto's, because I know that these topics, probably also this book is also part of his thinking of what law should not only be studied, but also transmitted and understood. It will be 5 years from his passing away next May. So it's already quite a lot. Just 3 elements I would like to mention for you. The first one is, I think when I met Alberto for the first time, I mean, when I started working, I was working in his law firm, not only at the university, also because I'm an international lawyer myself. So I was a bit special as a pupil of Alberto. But I was coming from abroad and from a very big American law firm, but I must say, it was perfect as a law firm. But when I sat in front of Alberto for the first time, and he gave me something to do and started explaining, I think I did understand what being a lawyer meant. And it was really able to open your mind. I don't know whether this is a good English, but the point is really being able to pass from one topic to the other and having a general understanding of what law is, and not only commercial law or private law. It was really able to think behind the institutions and the schemes. And it was really, for me, it was a way to learn. It was really the real beginning of my career as a lawyer, or probably also as a scholar somehow, because it really helped me a lot to understand how you can walk around law and make sense of everything. With this very specific characteristic of Alberto, Alberto in the Italian Academy was known for that. He was a professor of commercial law. He was known for what he did on protection of minorities, on patronage, of course, also on insolvency. But what was mainly remembered and noticed of Alberto was the capacity of speaking and connecting on every kind of topics. And this is what made him able to be so good at UNCITRAL when he was negotiating, and why he was so good when he was president of UNIDROIT. Because at that point, comparing legal institutions in different countries makes the difference, because you have the basis to do so. So I stop here because I know that you are late, but really, I think this book, or in general, everything which is done is really represents Alberto. So thanks a lot for this, for somehow giving a tribute to him also with this book and the discussion of today. Thank you.
Grazie mille, Maria. So we should maybe perhaps set up the first. No, sorry, your turn now. Sorry, Janice, I'm very sorry. It's also very early for me.
Thank you, and benvenuto and buongiorno. Welcome. We have a modest group here and a much larger online group. So just to tell the people that are here, the facilities are over there through that door. When we come to the panels and the questions and answers, the chair of the panel will do their best to watch for flags on the computer from the international audience. The symposium is very timely. We are indebted to UNIDROIT for sponsoring, as well as the International Insolvency Institute. And of course, you'll have seen on the cover slides and on your agenda, the academic institutions that have also been supportive, as well as IVAS, which is the Resolution Authority for Insurance in Italy. It's timely because, first of all, some of us have just come off 3 days of intensive discussions on a new legislative guide that's being developed by UNIDROIT, one of its working groups on bank liquidation. And so it's an opportunity. It was an opportunity. There are 17 central banks involved, resolution authorities, deposit insurance schemes, and various organizations trying to build a consensus on that. But today actually pulls back and has a wider angle lens in the sense that we're talking more broadly about resolution. We're talking more broadly about financial institutions, so including insurers on both the P&C and life and health side, as well as a range of banking institutions. It's also timely with the publication, as the president mentioned, of a book of which I am one of the authors. So I titled financial institutions in distress. I should know the title off by heart: Recovery, Resolution, and Recognition, which is really the work of 8 authors from all over the world who have worked in more than 30 countries in insolvency law. So our best efforts to try and think about how one takes some of these issues that we're facing. As we all know, the global financial crisis, which of course, unbelievably, is coming close to 20 years now. It's hard to believe. And we found, of course, all sorts of gaps in our regulatory framework and really an inability to really understand some of the issues that arose with a then new financial products and systemic risk. I think what's timely now, of course, is that we're seeing some failures of financial institutions, both on the insurance and banking side, and we're realizing that perhaps all our tools aren't quite doing everything that we thought they do. So the audience, both online and in person, have a wealth of experience. And so we don't see this as presenting and sharing knowledge. We see it as an opportunity to advance some of the discussion on these issues over the course of the morning. I will say, though, just my word on Alberto. I mean, Ignacio Tirado is going to speak at the end also, but in addition to everything that the president has mentioned, Alberto was also a master chef, if you didn't know. And he was one of the authors of this collaboration of 8 authors we affectionately call the Bowen Island Group. I live on an island off the coast of Vancouver in Canada. And so this is actually one of our meetings on the last book, and also him cooking in my kitchen. And I just remember with great affection, not only his wisdom and all of his incredible insights, both at Insutrel and UNIDROIT, but also as this extraordinary individual. So with that, I'm going to call up the first panel and welcome.
So we can see Alberto and Edith looking at his phone. Il telefono di Monica.
Well, good morning, everyone here and everyone remotely. The first panel is going to concentrate on the sort of institutions which are suitable for the measures which are being proposed. So in that sense, but only in that sense, I suppose, is it a setting of the scene? And the subtitle says not just for systemically important banks, which is an important qualification because the focus inevitably and rightly immediately after the financial crisis was on the most important institutions which could have worldwide effects in the event of their collapse. But as we all know, it's like the wings of a butterfly, isn't it? I mean, you can have one small savings society going under in Ohio, and before you know it, it's spread, the contagion has spread throughout the financial world and worse still beyond it. So identifying the institutions which are properly the subject of the sort of cross-border measures which are the subject of discussion is a very important first step. And also, as I perhaps following from what I've said, this isn't the focus is not, or certainly not just on the major financial centers as we know them today. Those are bound to change over the course of time anyway. But the reach has to be far wider than that. And the composition of the panel this morning will reflect the scope of the nature of this work and the intended catchment, as it were, for this. I won't really need to introduce, I certainly don't need to introduce Ignacio, who will be speaking shortly. We'll be joined shortly, we hope, by Monica Marcucci from General Counsel of IVAS. Sumant Batra, we hope, will be joining us remotely. He's here. I'm told that's excellent. Sumant, unfortunately, has not been able to get here despite his very best efforts and those of others with the relevant passport office. We're joined from Brazil by Vivian Graci Sampaio at the end here. Vivian, very welcome indeed. And also by Elsie Addo Awadzi from Ghana, who will Deputy Governor of the Bank of Ghana, and it's a great pleasure to have you with us today, who will be able to speak to the African perspective as well. So you'll immediately see that we are covering several parts of the globe, briefly, inevitably, over the next hour or so. So with no further word from me, I will pass over to Ignacio, if I may.
Thank you, David. Good morning again. So first of all, I'd like to clarify that I'm participating in this panel not in my capacity as Secretary General, but as one of the co-authors of this study. And nothing I say can be attributed to UNISRA in any possible way. The reason for having this conference today next to the working group is not that it's related to the working group, but the people who were coming to the working group would be interested in this type of subject matter, and that's why we're doing it today. And also to reduce the costs of having the people travel and present, but it's completely independent from the work that's been discussed. The focus of the analysis of today's seminar is, as Lord Richard said, the cross-border aspect of banks, really, and it's done from a mostly from private international law perspective, because that's perhaps where more deficiencies are to be found, because that's where the dichotomy between sovereignty that countries want to preserve and the need for coordination and cooperation is more clear. So while the analysis has a lot of many theoretical pages and chapters, the idea is for all of it to converge in a proposal to try to grapple with the issues that exist in cross-border cooperation and coordination. So my brief intervention would be a little bit to talk about the general findings of the lengthy research we have conducted concerning the situation of cross-border coordination and cooperation of different banking systems, the we analyzed what we thought would be representative banking systems in several. We analyzed the banking system, the resolution system, the institutional framework, and the cross-border section, all 4 items in a number of selected jurisdictions. For example, of course, our capacity was very limited. So in Latin America, we analyzed Mexico and Brazil, although it doesn't have a specific chapter. I might be forgetting a few, and in the Americas, Canada and the US as model systems, which have been to some extent influential in other lawmaking in different places. In Africa, we did Nigeria and South Africa, and there she also with a close eye on Morocco, because Morocco has a very important cross-border activity in terms of banks. We did the analysis in Asia. It was a quite lengthy analysis because we did China, India, South Korea, Japan, and the 2 financial hubs, Hong Kong and Singapore, and then the European Union, of course, as well. And, so this general review of the systems in these 4 categories show the picture, or the main conclusion of which was there are no 2 systems alike at all. Each system has its own very clear idiosyncrasies because it's a combination of market design, private sector and public sector involvement, economic and social development, and also the approach of the government in place to handle bank resolution issues. So that combination, all shaken up, stirred together, gives a picture which is different in every market. So, and this, of course, will come to no surprise to anyone. Another of our findings, which might be a bit less intuitive, is that, of course, the large portion of banks actually do have a cross-border component. The global and domestic and regional and domestic SIFIs have clearly a cross-border component, but even medium and small banks do have a cross-border element, which is interesting, even if in access to acquiring sovereign debt, not necessarily of their own country only, and in going to financial markets for financing, interbank lending across borders. So the cross-border element is present also in the smaller section of some banks, if not all, of course. As will be explained later, perhaps, and some detail is dedicated to it, this is, of course, handled through mostly international goodwill, because I think we want to call it guidelines and cooperation agreements. Very little or no real binding instrument between nations in this regard. So this everything is very soft and everything is very much about coordinating and sharing information, but we'll see if we really share the information when the moment comes. That's a little bit the impression one gets when one reads the actual agreements, the documents, those that are available online. Of course, we drew substantially and heavily on the public documents issued by the FSB, the IMF. That was mostly our source of information, but we did find other sources as well. So, for those central bankers in the room, it will be no surprises. You have much more information than we do, but that's what's out there. As of late 2021, the crisis management groups with resolution plans were established for all global SIFIs, which is very good news. Same for COAX, the cross-border agreements for 90% of the global SIFIs, and adherence to ISDA's resolution stay protocol by also 90% of all the global SIFIs. So the situation for the, let's say, upper tier of the largest financial institutions is pretty wholesome and quite good. The problem is that that's where the good news end. And again, following data from the FSB, also, it was interesting to look at the data published by the FSB because much of it is directly comes from questionnaires filled out by central banks, the answers to which are not always easy to compare because they answer different things. And even if in our project we see this is a problem, so this is always a problem. And so it's difficult to compare because the answers are not always answering the question or aligned in the way that they describe. So the information is limited there. But for example, an interesting element I think that describes the need for enhanced infrastructure there is the fact that, again, according to the FSB, it was reported that 10 jurisdictions, including the EU as a single jurisdiction, have one or more foreign-owned domestic systemically important banks, half of which do not participate in any cross-border resolution agreement. So you have a CIFI in your home, which actually is owned by a foreign group, and it's not part of an adequate, stable agreement. So that it poses indeed some potential risks. Of course, stable agreements exist between in the regions, in Africa, in the US, in America, sorry, in Asia. But these are meetings, informal meetings of central banks and supervisors, and not much beyond that. At least that's what's reported. So while there are agreements to share information, they are very soft agreements, and the flow of information on its face seemed quite limited, or at least subject to improvement, being how can I say, prudent about it. So there is a need for enhanced a framework which is stronger and which provides more certainty for cross-border issues. And I'll finish just by saying that the way we looked at this is we see two ways forward. None of them is very easy. One of them is increased harmonization in supervision and also in resolution rules would substantially lower the concerns of the authorities in the sharing of information and in the cooperation, because if they're familiar with what's there, that could probably help. Certainly some harmonization even in the terminology used. Triggers are not the same in different countries. Just that already is an issue. And perhaps what we thought could be the better solution would be to, if an agreeable model law which took into consideration the safeguards that countries want to have was approved and adopted by as many countries as possible to harmonize. So a model law, for those of you who are less familiar with that, is not a binding instrument. It's just it's a soft law instrument, but it becomes hard law by adoption by the state as national law. And there is a proposal in this book about that as a possibility, and we explain why we think that would solve many of the problems while still catering for the need to preserve sovereignty when it's justified. Of course, the model law would provide adequate solutions to recognition of resolution measures, etc. But I think I've spoken enough, David, so I'll just hand it over to you. Thanks.
Well, thank you very much, Ignacio. So I'll turn over, if I may, to Monica.
Thank you, and good morning to everybody. And sorry for my late arrival, which has a little bit changed the order in the panel, as my task was supposed to be that of opening the panel with a representation, an illustration of the international framework that we have in place, so that Nacho could give more detail on how it works in practice and what the information we have on its real functioning. But I think I still can do my job.
There's no reason not to have Act 2 before Act 1.
In the sense that, of course, if in describing what the framework that we have in place for cross-border resolution, it's necessary to start from the FSB key attributes, which have already been mentioned by Nacho. And what I would like to highlight is that this key attributes really mark the turning point in the evolution of financial regulation, as it was the first time ever that after a crisis, regulators did not restrict just to improve prudential framework and to reinforce the powers of resolution of authorities, but decided to intervene on the regulation of insolvency, because it was recognized after the global crisis that even if we have a robust and sound prudential system, situation of distress cannot be totally excluded. Probably you already mentioned some features of this of the FSB framework, whose main goal was to ensure the preservation of critical functions, to promote cross-border cooperation and coordination, at the same time limiting recourse to public funds. And to do this, it introduces some tools which are intended to operate not only when in resolution, but also ex ante in the planning phase, so as to have arrangements already in place if failure materializes. And these resolution tools indicate the very intrusive powers that resolution authorities should have at their disposal in order to address a crisis and to make sure that it would not end up in disruptions in the system. We are familiar with the concept of transferring assets to a bridge bank or a special purpose vehicle, or to absorb losses through this new instrument, which is the bail-in, or to stay early termination rights under financial contracts. All these tools we know also based on early jurisprudence that we had on resolution, that they may affect individual contractual and property rights. And for this reason, the key attributes provide a number of legal safeguards to ensure, to protect creditors and shareholders by ensuring that the losses that they will suffer will not be greater than the ones they would have suffered in a liquidation. After this brief description of the specific framework for failing banks, let me say some words on the resolution of insurance companies, because also insurance companies are subject to an harmonization process as to resolution. They are subject to a specific annex which was added to the key attributes in 2004. And through this annex, the FSB has given guidance on how to deal with the crisis of insurance companies based on principles that are largely inspired by the same core principle of the key attributes, but also take into account certain aspects that are unique to the crisis of insurers. And also this was an important change in the approach of regulator as well, because prior to 2008, the common approach was to focus mainly on consumer protection, but only after episodes like the AG crisis during the global crisis, it became well known that great harm can occur also as a consequence of the crisis of a large insurance company whose assets are primarily invested in bonds and stocks. But let me say that also more recent crises, either in Europe and also just now in Italy, are demonstrating that even an individual insurer with more traditional activity can pose systemic risk in case of failure. And I will turn later back again on the crisis of insurance companies. What I would like to highlight here is that thanks to the FSB key attributes, we can say that a certain degree of harmonization has been achieved so far, at least in the banking sector. The discourse is different for the insurance sector because due to the traditional focus on consumer protection, it ended up being less harmonized in general compared to the banking sector. And Nacho indicated some aspects that still show that this harmonization might be not that wide as expected, but still it's a very important step beyond having some general common rules that allow authorities to speak the same financial language. But the FSB itself is aware that convergence of rules is not probably, it's a prerequisite, but it's not the unique thing which is important, but because cooperation needs to be improved and structured, as it cannot be left to the authorities' own initiatives. And for this reason, the key attributes set out a number of cooperation and sharing of information mechanisms. Some of them have already been mentioned by Nacho. For instance, the establishment of crisis management group, information sharing also in bilateral relationship among authorities. And there are also specific provisions on competence and finally on recognition as a way to give legal effect to resolution measures in domestic environments. These instruments, as the practice has, the experience has shown so far, have their vulnerabilities. If we think of course, of resolution planning, resolution agreement, they can help a lot in a cross-border context, as they indicate some predefined measure that can be that can be immediately activated. But still, there is uncertainty as they can really be enforced if a crisis materializes, because the underlying assumption might have been changed when this happens. Also because sometimes they are not that precise or even capable of being immediately enforced, and still they are not able to overcome obstacles posed by divergences in the legal environment. And I will say something on this later. At the same time, resolution planning is very important. For instance, it proved to be very useful in the management of the crisis of Credit Suisse, because at the end, even if resolution was not used, there was a very advanced planning which had made a resolution option still possible and ready to be implemented. Still, that's not granted in many cases. And uncertainty exists also because there still can be a lack of trust among the involved authorities. But also as regards institution-specific agreement, the COAGs, the main problem, I think, is that they are more of a procedural nature. So they cannot really be an enforced application in practice, and they cannot overcome some obstacle that can be posed by, as I said, by divergency in national rules. As the FSB has noted in a report which was published last week, still, even those failures that occurred in the first quarter of 2023, including and in particular the Credit Suisse case, they showed, on the one hand, that the framework, the FSB framework, is sound and robust, and it cannot be put under discussion as such, and we can agree on that. But the FSB itself has to recognize that some operational problem, at least in the implementation, still needs some improvement and some further analysis. That's an important issue, because I don't know if in the case of Credit Suisse it was just a problem of operational aspects, but I think that in general, for instance, divergencies in the substantive law applicable to ranking of creditors, or of the fact that the general framework for ordinary insolvency procedures for bank does not exist so far, until at least until the UNIDROIT project comes into reality. And these divergences are very important and can really affect the possibility to implement an agreed solution, in particular, as they can create problem in the due application of the principle of no creditors worse off. If we go back to the Credit Suisse case, I think it's also important to underline that there can, even in that case, probably political constraints have had a role in preventing opting in a resolution scheme, because as already some commentators argued that implementing the single resolution that was already agreed by authority could have put at serious risk, for instance, the derivatives subsidiary in London, which was systemic there. And then this would show that going for a single point of entry approach can be sometimes unacceptable, at least for those countries whose authority would be set aside in a CMG. And this app happens because in CMGs do not include necessarily all host jurisdiction in which a GCP has locally systemic operations. And this is because of operational efficiencies. But of course, in that case, what happens is that it's difficult to align interests among all the involved parties, because host jurisdiction which do not participate in a CMG can have defeat information, and they can make hear their voice solution. So this shortcoming in the absence of divergences in the. Let me remind here that there was indeed the bail-in, implemented bail-in, time-consuming the US security law, which sale of TLAC in the hands of was incompatible with the action. But even if there are normative, there is this issue. Authority can be under locally to pursue the interest of for instance, of local stakeholders, and this made any outcome of an agreed solution, or even in the present of street cooperation, uncertain. And then this problem is exacerbated, of course, in the case of multinational entities that operate in many different various jurisdictions. And let me say something also on multinational insurance companies. Probably in the insurance sector, this problem is even more sensitive, considering the higher level of internationalization of insurers, which are, we know many global players. And if we mention reinsurers, this is even more sensitive. Consider that it's a highly concentrated market with global player operating around the world to enter new markets, and in particular to differentiate risks. And an interesting to say is that the second largest share of the market of insurers is made of companies located in Bermuda. So we can imagine how a coordinated solution under the resolution framework could be achieved, and if ever a reinsurer in one of those countries, in an offshore country, has to fail. And it's important to add that recently the systemic concerns posed by reinsurers are increasingly perceived, especially in consideration of the retrocession market that creates stable links among the majority of reinsurance, thereby creating a channel for amplification of shocks, but also in consideration of the increasing risks they are exposed due to climate changes. So they should be, our attention should be very much focused now on reinsurance. But even without bothering the reinsurance sector, let me say also that insurance really can create very unique problems in a cross-border context in case of resolution. One of the main problems has to do with valuation of the assets, because we know that we are dealing with companies whose liabilities are, many of whose liabilities are subject to future and uncertain event, and this creates problem in making an ex-ante evaluation in a hypothetical bankruptcy scenario. But also the failure of a large life insurance company whose liabilities are accompanied by long tails in terms of future payouts, can exacerbate the risk in a cross-border context. And even if we are dealing with an individual insurer, with life insurer, as is the case of a recent crisis we are addressing now in Italy, there can be some systemic or the delicate problems. In Italy, we don't have at the moment a comprehensive framework for resolution of insurance company. We don't have it even in Europe, because even if we probably by the end of the year, a new directive would be adopted, the IRRD, and we had to deal with this with the troubles of this insurance company named Eurovita, and we were facing the risk of a run of policyholders who were due to an expectable mass redemption rights by exercise of redemption rights by them, and we couldn't only prevent this by using powers that we had never used before, which was the power to suspend the exercise of redemption rights, and this gave us the time to develop a solution which was not that easy with reference to this company, and we really required strong support by the market, strong support by the supervision authority. So if it is so difficult to achieve coordination even in a purely domestic context, we can imagine how difficult it would be in a cross-border context. And all this to say that I cannot but converge with what Nacho previously said, that no matter how well developed an international framework aimed at harmonizing substantive rules, what is probably needed to have a further implementation to have realistic, at least coordinated solution for GCFIs would be to have a legally binding instrument based possibly on a model law, because this would allow to overcome at least problems of mutual trust, problems of divergency under local law. And as some commentators said, with reference again to the Credit Suisse case, having one authority in charge of the resolution for all the group would be probably the best solution in these cases. Thank you very much.
Monica, thank you very much indeed. Just a couple of observations, if I may. It's interesting to note that the United Kingdom was faced with the problem of a major insurance insolvency in the 1860s, when a company called the Albert Life Assurance Company went bust. There were absolutely no legislative tools in place, and there was extraordinarily, there was an arbitration to try and resolve the problems of the Albert Life Assurance Company. But it led to legislative changes starting in about 1871, which involved sort of two stages. First of all, policies were looked at to see if they conferred excessive benefits, maybe to get market share or whatever. Policies were written on fairly uneconomic terms. The excessive benefits were then removed from those contracts. And then the next stage was to reduce by 10% all benefits under all contracts. And then the provisions for transfer of the business to insurers willing to take on the new business. So our Victorian forebears had in mind a sort of bail-in for resolving these problems, bringing things more up to date and really trying to underscore what you said. Many of you will know that the critical moment in September 2008, after the US government decided not to intervene to support Lehman's, a decision that was taken on, I think, Sunday, the 14th of September. On Monday, the 15th of September, when Lehman's went into insolvency in New York and London, the US government was faced with the prospect of AIG becoming insolvent. At that point, the US government intervened because, as it was said by one commentator, the financial crisis was moving from Wall Street to Main Street. And I think it underlines the point you make, that insurance companies, insurance businesses, are an absolutely key part of the international financial structure. And the effect that a major financial failure or a major insurance event can have is of great importance. Again, a historical example was the San Francisco earthquake in the 1906 or whenever it was, which naturally led to a huge sell-off of bonds and equities and so on. So I think the focus, if I may say so, I think your focus on the problems faced or posed by insurance businesses and concerns are of pressing urgency. And I think it's absolutely right to have insurers as much in focus as banks. So Monica, thank you very much indeed. And I think now, should we see if Sumant is available on? Sumant, are you, if we can?
Yes, I'm here.
Excellent. Well, Sumant, thank you. Can we pass over to you, please, to give us an insight into the position in India?
Can I just
Thank you
say,
so much.
sorry, Suman, those of you who are sitting on the side or in the back, feel free, of course, but there's plenty of space here, so don't feel shy about it. You can still leave early if you want.
We've got, as my old Professor Gareth Jones used to say at Cambridge, there are plenty of cheap seats here at the front.
Right. All right. Well, thank you, Mr. Chairman. Thank you, Unitra, III, and other partners for offering me this opportunity. I appreciate it very much. And I'm, of course, disappointed that I couldn't be there in person. But I have to say that over the last 3 years, I had the privilege of attending the working group meeting virtually. But, I was so impressed by the richness and the quality of discussions. I wish I could be there in the room to feel the energy, but even sitting thousands of miles here, I could feel the intensity of the discussions. And I learned a lot, although I was there mostly as an observer, my first meeting, but it was a great experience for me, learning from such immense contributions that each participant made. I just will make 3-4 quick, broad comments and maybe some subsets of those. Let me start by saying that we do not have at the moment in India a standalone resolution framework for financial institutions. We deal with insolvency, resolution, or failure of banks as a combination of 2 legislations. One is the Companies Act, which has the enabling provisions for liquidation of financial institutions. And then there is this substantive law that deals with the regulation of the banks, where the power to the bank regulator, that is the Reserve Bank of India, exists to initiate an insolvency, and also, of course, also to a large extent, drive the process under the supervision of a company code. Not the best of the efficiency, but given the resilience that the central bank has shown in some of the most difficult times as well, we've been able to successfully and largely effectively also with some of very significant bank failures or distresses that we have experienced. More recently, you'll be surprised when it comes to smaller banks which may not have much cross-border issues or even pan-India issues. You'll be surprised that in the last 6 years, nearly 27 smaller banks have been liquidated, and 42 have been merged with one another, all using the central bank powers. But yes, these are smaller banks and did not have much implication beyond the regions in which they operated. But 3 large situations that we have had of significance where there were cross-border issues also have been dealt with, if I may say, with certain amount of efficiency and effectiveness. Although, of course, one can safely say that had we a more robust law in place, the outcomes could have been even better. And the first one, of course, was in the early in 1991, which all of us would be familiar of, is the Bank of Credit and Commerce International insolvency back in US. we had two branches in India, one a larger one in Mumbai, which is the financial center in India, as you know, and another one, a smaller one in another city. And the central bank moved in very, very quickly to file a liquidation application for the dissolution of that branch, treating it as a separate entity, as a company. Although it was just a branch, but even a branch can be treated as a company in country under these specific laws. And the High Court permitted the dissolution, but as a part of the dissolution, the entire business was merged with India's largest public sector bank, that is the State Bank of India, as a result to protect the interest of the stakeholders. So we didn't really have any significant haircuts to be taken by the creditors or by the investors or by the depositors. So it didn't really create any tremors, but it was a test case because here was a branch of a foreign bank which was facing liquidation back home, and how were we to step in to minimize the damage and to deal with it in an efficient manner. And that was as back in 1991. More recently, in 2004, we had the failure of the Global Trust Bank. Now there, because the liquidation or resolution could have taken time, and probably the central bank felt that it may not have been the best solution, what the government of India decided together with the central bank was to merge that bank with one of the other public sector banks of India. As again, because it was felt that the way the economy was positioned at that point in time, I don't think we could have afforded at that point in time to be able to have that kind of failure of a significant bank, or the bank of a significant size. More recently, it is a Yes Bank, which in 2020, just about a little over 2 years back, where suddenly there were certain news reports of the bank facing financial difficulty and being in trouble, and they were accused before the bank for withdrawals, and the central bank intervened, and within a week there was a resolution plan prepared, an administrator was appointed, and a team of experts was given to the administrator, and 3 years down the line, the Yes Bank is already beginning to come out of difficulty. But these were obviously where the central bank were able to use its own powers and with the support of the government and all the mechanism do it. But that does not mean that the need for a robust law for dissolution of financial institutions or deal with them in the financial difficulties is not there. This recognition, in fact, was felt as far back in 2011 when the government of India set up the Financial Sector Legislative Reforms Committee, which recommended that there is a need, rather a pressing, urgent need, to have a separate legislation or framework to deal with the distress in financial institutions. And as a result of that, in 2017, a bill was tabled in the parliament, which was called as Financial Resolution and Deposits Insurance Bill. I had the privilege of studying that and also proposing before the parliamentary committee. In my personal opinion, it was fairly high standard document. And obviously with time it could have been improved further, but it did have all the elements that we expect, capturing the key attributes and the expectations that the global financial institutions and the global regulatory bodies would have from a law of that kind. But for the reason that it was not discussed with the stakeholders as effectively and as in detail or in depth as it ought to, there was a lot of pushback, and especially with regard to the lack of understanding about the bail-in provisions. And as a result of that backlash, that bill was withdrawn a year later on the recommendations of the Joint Parliamentary Committee, which was examining that bill. As we speak, there is a lot of activity going on in the back rooms of the central bank, the Reserve Bank of India, in the Ministry of Finance, the concerned departments, and within the banks. There is a draft that is being worked on. The Reserve Bank of India is a part of the working group at the UNITROI, and there have been a lot of learnings from there. And hopefully next year we would see the bill being tabled in the parliament after the general elections and the new government is formed. I just want to bring one more development which has taken place in the meantime. Very quickly, I'm mindful of the time. That recognizing that that this is a big gap that exists in the financial sector. The government decided to provide a stopgap arrangement in the meantime in the Insolvency and Bankruptcy Code, which deals with the insolvency of corporate enterprises, which was enacted in 2016. And because there was some stress in some financial service providers, the one category which is in India called as non-banking finance companies, which do most of the activities which a bank would do, except for taking deposits from the market in terms of individual deposits by the banks, by the individuals as saving accounts or current accounts. And there were in particular two which were in financial distress. In order to find a resolution mechanism for them, the Insolvency and Bankruptcy Code was amended, and a special set of provisions was included to make way for resolution of these kind of financial service providers using the Insolvency and Bankruptcy Code of 2016. A separate set of regulations was provided, and this could also be again initiated only by the central bank and not by individuals or creditors or otherwise. We have had 3 insolvencies filed of these non-banking finance companies in India in the last 3 years. One of them has seen a successful resolution plan, which is almost implemented now, and that company has been successfully taken over by another bank using the Insolvency and Bankruptcy Code process. The other resolution plan has already been approved by the Committee of Creditors and is awaiting the sanction of the Bankruptcy Tribunal. And in the case of the third, there is the process is at the advanced stage, and we've seen that that process has worked fairly efficiently. But at the same point in time, I don't really think that it is expected that that would really stay as a permanent process. Once we have a comprehensive law for the banks and financial institutions, I'm sure even for the non-banking finance companies, it will go back to that law. Now, the last comment that I wanted to make was, at this point in time, there are 2-3 things that have been discussed at the policy level about the choices that we may need to make in future. Whether the new bill that has to be introduced should really be made as a part of the Insolvency and Bankruptcy Code, because it's a comprehensive code which deals with insolvency of corporate enterprises, limited liability partnerships, individuals, small, medium enterprises, partnerships, proprietorships, and whether therefore the bank and financial institution law should also really be made as a part of this as a comprehensive code. 2, whether we should have a separate bankruptcy tribunal for that. Earlier there was a resolution corporation and other regulator also, but the debate also is whether we should have a separate regulator or should be given to the regulator that has been created under the Insolvency and Bankruptcy Code. So these are some of the policy choices that will have to be made over the next 12 months or so. But at this point in time, this is a very alive issue. This is a very burning issue. This is a very pressing issue. And as India aspires to become a developed country over the next 2 decades, recognizing that it is the 4th largest economy, the fastest growing economy in the world, at least one of them, there is a mindfulness that there is a pressing need to provide a legal, legislative framework, institutional framework to deal with the financial institutions in distress. I'll stop here, Mr. Chairman. Thank you.
So, man, thank you very much indeed. Just by way of footnote, it's interesting that you should have recalled BCCI and the way the branches in India were developed, because BCCI really brought home some of the many difficulties that existed with cross-border banks. Some of you will remember that the holding company for BCCI was incorporated in Luxembourg. It had 2 principal subsidiaries, operating subsidiaries, one of which was incorporated in Luxembourg and was subject to banking supervision in Luxembourg, although its main business was conducted in London. And there was involvement of the Bank of England in London. Its other main operating subsidiary was incorporated in the Cayman Islands and was subject to some level of supervision in the Cayman Islands. The one thing that all the regulators did do was, when it was clear that the whole thing was just a fraudulent enterprise, was to cooperate to put BCCI worldwide into liquidation by coordinated action on the same day. But it certainly showed up a lot of gaps in regulation with a certain amount of, well, this was your problem, no, it was your problem. It also gave rise to problems because of, I mean, BCCI was not a suitable candidate for resolution. There was nothing really worth saving in BCCI to speak of. So it was bound to be liquidation. It then gave rise to the sort of problems that Monica was mentioning of different distribution problems in different jurisdictions, in particular with the Luxembourg branch, or company rather, being in liquidation in Luxembourg and in England at the same time, with coordinated distributions. But Luxembourg law prohibited set-off, whereas English law required set-off. So you had that sort of gap, which in the end was met by the English distribution regime giving a credit to those creditors who had been deprived of set-off in their distribution in Luxembourg. So in the end, a solution was found to sort of try and marry that. But BCCI, in a sense, in the modern age, was the first major international banking failure. It was a one-off because it wasn't caused by some systemic problem, but it certainly showed up many of the shortcomings that then existed, some of which we've passed on from. So with that, can I please invite Vivian to address us? Thank you.
Thank you, Mr. Chair. I'll start by thanking Ignacio and Janice for the invitation to speak and share the Brazilian experience with you today regarding bank resolution and cross-border challenges. I'm a bit nervous, and when my brain and my mouth work in different speeds. So I'll try to use my best English to make my message understandable to all of you. I'll try to provide you with a policy view and the challenges we face in practice when we're speaking about facing cross-border challenges in the coordination and the cooperation for preparing for crisis management of non-GSIBs. In Brazil, there is only one GSIB operating with substantial operations for the global group, which is Santander. All the other systemically important banks are domestic ones, two of them under private control, and two of them under public control. The Central Bank of Brazil, I need to provide you with a short overview about the Brazilian institutional framework, which will shape up the manner at which we can move forward in cooperating and the way we decide on our working processes and how quick we can advance with these processes. The Central Bank of Brazil is the supervision, regulation, and resolution authority for almost 2,000 financial institutions, of which 176 are banks. We have two deposit insurance funds operating in the country, one for typical financial institutions and banks, and one for cooperatives. They are both private non-profit deposit insurance. Both mandates are Paybox Plus, so they are in charge of the payout of deposits as well as providing liquidity assistance to the participants and supporting these institutions in restructuring operations before the initiation of a proper resolution regime. Another interesting but not so happy aspect of our reality in Brazil is that our laws date back to the 70s, 80s, and 90s. This resolution legal framework has evolved from crisis to crisis, which puts us in a situation that sounds quite similar to the Indian situation. We do have powers and tools that have worked very well to handle the crisis we've faced so far, but we do need to move forward and update our toolkit, update our powers, especially in light of the key attributes that emerged since 2011, 2014. We have been doing a lot of work in trying to update our legal framework. In December 2019, we sent a new bill of law to the Congress. Some of you may have already heard about this bill of law, especially I'm seeing Ruth here, and for certain she has heard about it because we have discussed it in different forums. But we haven't been able to advance much with the appreciation of this bill of law in the Congress. So meanwhile, we are trying to modernize our working processes based on the current powers that the Central Bank of Brazil already has. So since 2016, we started elaborating the first resolution plans for systemically important banks in Brazil as a matter of a working process, taking advantage of the fact that the central bank has all these powers on supervision, regulation, and resolution. We do have access to a huge amount of data about these institutions, which made it easier for us to implement the working process on resolution planning. And since 2019, we established a routine involving the banks in the process of resolution planning, requiring information, detailed information, and more recently, demanding some more effort from these banks to test strategies and to test their capabilities to provide information in peace and in critical times to the institution. Since 2015, 16, when we started working properly on resolution planning, we also have been putting a lot of effort in improving our relations with the major jurisdictions at which our banks have international exposures, and probably that would require extra efforts in case of crisis. In the beginning of 2021, we were part of a cross-border crisis simulation exercise sponsored by the FSB, along with Paraguay, Argentina, Uruguay, Chile, and Colombia. And this exercise has been a cornerstone to show us the strengths and weaknesses of our system and shape up the agenda, the resolution agenda that came after the exercise, and direct better our efforts towards the points that we would need to improve faster. In the same time, we also had an international project sponsored by the Inter-American Development Bank with all the same countries except from Colombia. The aim of this project was to identify the asymmetries and the convergences among the resolution frameworks in place in Brazil, Argentina, Uruguay, Paraguay, and Chile, and to investigate the possibility to establish a permanent forum for cooperation among these countries in the topics related to resolution. This project is almost over, but not over yet. And we have been successful in many aspects with these initiatives. And I would highlight that probably the most important one was the strengthening of the network, because we know people we need to reach out to in case we face a crisis. We know each other better. We know the constraints presented by the legal frameworks better because we had the opportunity to share this information beforehand. And I would say in some previous interactions, one expert from the South Cone reporting a situation they had with a cyber attack in a bank, and we were discussing about the potential obstacles among the different legal frameworks and the existence or not of an effective MOU, and they replied, when the crisis hits you, you not necessarily will look at the MOU. You will pick up the phone and you need to know who is going to answer your call. So this was crucial for them to handle the situation with the cyber attack. And this came to my mind as a lesson learned. So which were the main takeaways of all this effort? As a result of the CSE, we could see that, yes, as Ignacio pointed out, and the study has already presented as a result, there are huge asymmetries among our legal systems. And yes, this is a challenge, and this is a challenge for many reasons, because these sort of asymmetries, they will impair most of the times some of the resolution strategies that we outlined for the bank, and we'll be obliged to develop creative solutions that will surpass these obstacles. And many times these obstacles are responses to previous crises that these societies have faced. So many times when I mentioned the Inter-America Development Bank project, Brazil started pitching for the project, and we invited all the other participant institutions to get on board. And at least twice we heard, yes, we'll go on board, but as long as this project does not require us to make any legal change in our framework. So yes, this is also a challenge, trying to operate with what is in place, because those obstacles are there for a reason, and they probably are there because they had to be built to respond to previous crises and to help to recreate confidence in the financial system. So it's not easy, like, okay, let's just rethink this obstacle and try to build a common framework. So you will find resistance many times. But yes, this was knowing the playing field where you're working is crucial to allow you to build up these solutions. It's no secret to all of us when we speak about resolution strategies, it's no secret that the optimal solution for a financial institution would be what we call a market solution, or a P&A, where it can preserve the operations of the institution and set up the problem. But in most cases, this solution will not be feasible due to time constraints, to competition limitations. So what we learned from these experiences is that it's crucial to test your strategies, to test your tools. This is why the cross-border crisis simulation exercise was so important, because at that time, we already had some resolution plans in place, and we had the opportunity to test the preferred strategies and to see if they would work or not. And we could find out that when it comes to our domestic territory, the strategy was fine, was solid, but in what related to the relations with other authorities, we would find severe constraints. And we had to change the way we approached these institutions. So in response to our participation in this simulation exercise into 2020, we set up a crisis management group for this domestic SIB, the biggest domestic SIB operating in Brazil. And we did so without a cooperation agreement. I'm repeating myself to those who have been with me at the working group yesterday, because I gave the very same example. But we decided to put this CMG in place based on the existing MOUs we had. We didn't go for a specific cooperation agreement because we felt that we already had enough legal security to proceed with the information sharing. And this has been a great experience. 3 weeks ago, we had another meeting of the CMG. We could see the evolution of the authorities in treating the information. The first meeting was quite difficult because we were not looking at the same data. We were not using the same lenses to look at the bank, but we did have back then the opportunity to converge our views. And in the second meeting, we could work better our information, and everything that has been shared was way more useful for us to coordinate the strategy for the bank. So the key messages when we talk about the challenges posed by cross-border activities of a bank, either a big one or a medium and small banks, is that it's crucial to have a cooperation framework in place. This is pretty much why we could set up the CMG, as I mentioned seconds ago. But most of all, it's important to strengthen the network. We will find asymmetries. I think that if there are asymmetries in Europe, which seen from outside seems to us as a much more uniform system, please can you imagine how the situation is in Latin America? So yes, we will have loads of asymmetries. These will create obstacles, but also the opportunity to negotiate solutions in peace times. This is critical. Have your solutions set. But most of all, and the third key message is test your tools, test your strategies, and most of all, test the capabilities of the institution. The institution is part of the process. Does not think that being in a group with authorities, you will have the best information. Until the time you decide to get into intervening in an institution, the institution has the best information about itself. So get the institutions involved in the process and test their capabilities. Recently, we had the initiation of 2 regimes in Brazil, small ones, financial companies, not banks. Luckily, I've been working in this area for almost 6 years, and no bank has been liquidated in Brazil since then. I'd like to think that I'm giving luck to the department. But yes, we've had some regimes with smaller financial corporations, and we had a huge problem in managing to extract the data to initiate the payout of deposits because we didn't test their capability to generate the database before initiating the regime. So this is crucial to do not disrupt the system. They were smaller institutions, and still we got over 100 complaints at the central bank about the delay to get the deposit payout. So these are my key messages based on the Brazilian experience. I hope this has been interesting enough to all of you, and I shall stop here. Thank you.
Well, Vivian, thank you very much indeed. I had the impression that your brain and mouth were working in perfect harmony. Elsie, please give us the perspective from Africa.
Thank you very much. And I'd like to start off by thanking Ignacio and everyone for inviting me to speak. I do not speak at this event as the Deputy Governor. It's not, so the views that I'm sharing will be very much my personal view, and as someone who very much is interested in this area. So basically the African banking landscape, and let me start off by saying that Africa is made up of, many of you know that 54 different countries, very different also. That's me. Very different, and for our purposes, oh my gosh.
That's
yeah. For our purposes, these countries also have different legal traditions. So we do have the Commonwealth, countries that have the common law traditions, and then we have the civil law traditions. We do not have yet sort of a regional economic grouping yet. We have the African Union that's mostly political for now. We do not have any Pan-African sort of banking union yet. Although of the 54 countries, there are 2 banking unions at sub-regional levels. So we do have the West African French-speaking countries that are made up of 8 countries that have a banking union with 1 common currency as well, with 1 single banking supervisor and resolution authority. And then you do have the Central African countries also in a monetary and banking union with 1 common supervisory and resolution authority. And then the rest of the countries have their own independent and domestic arrangements. There are 2 GSIBs with operations in Africa. This would be the Standard Chartered Group from the UK, and then the Société Générale. There used to be a third one, ICBC from China, that at some point was a GSIB, that actually has 20% shareholding in a South African banking group that has quite a number of subsidiaries across the continent. Now, these two GSIBs operate in a number of African countries through subsidiaries and not branches, I must say. In addition to the presence of GSIBs, we have the presence of what we call Pan-African banking groups. These are banking groups that are headquartered in one African country or the other. There are quite a few, 3 or so from South Africa, that operate in a number of countries in Africa. And in some countries, like in some of the smaller Southern African countries, these banks are the only banks that operate, all of whom are South African banks. You do have some of these Pan-African banks that are headquartered in Nigeria. Some are headquartered in Morocco. Some of these groups, some are headquartered in Togo, which is a French-speaking country. Some of these Pan-African banking groups operate in as many as 36 of the 54 countries in Africa, right? And so they are not inconsequential. These also usually operate as subsidiaries in the host jurisdictions. So this is sort of the lay of the land in terms of the landscape. What are the cross-border related issues for our purposes? Because they're organized mostly as subsidiaries in the host jurisdictions, there's already that ex-ante ring fence, right, of assets and liability. So that makes it a little easier in terms of containing risks in the various host jurisdictions. I must say that sometimes also works against effective cooperation, because the host authorities really don't feel there's a problem. They have 100% ability to act and don't always feel inclined to cooperate, right, with other jurisdictions. So that could be a drawback as well. There are shared infrastructure, which is one of the emerging risks. So we're usually used to home host jurisdictions, but increasingly we're seeing that these banking groups operating in Africa, whether the GSIBs or the Pan-African groups themselves, operate through sort of shared core banking systems, right? Very critical core banking systems. And as a result of a lot of the investments in technology, in terms of, going digital with their services, we're also seeing sort of shared cybersecurity infrastructure and the like, sometimes sort of hosted in the continent in one of the jurisdictions, but sometimes outside totally. There have been instances where the shared infrastructure is hosted in India, for example, so totally outside the continent, but then sometimes in some country in the continent. So that's one important thing to think about in terms of cross-border crisis management. A key issue is the fact that resolution regimes across the continent are evolving. Some countries have the full suite of FSB type tools and some do not at all, or are in the process of developing their frameworks. Ghana, for example, has a 2016 banking law that provides broadly the FSB type tools, including the bailing tool. And we had to test this soon after the law came into effect, 2017, by closing 2 banks, resolving 2 banks. And within 2017 and 2019, we had to close, we had a major banking crisis. We had to use the new toolkit and closed 9 systemic banks, as well as about 45 savings and loans companies, quite big, not as big as the banks we had closed. And unfortunately had to close over 390 smaller microfinance companies, right?
Which were not deposit taken.
Oh, all deposit taken. Yes. Really to promote, these were licensed to promote financial inclusion, right, in the remotest parts of the country and all of that. Somehow they had begun to get into all sorts of practices, right? There was a huge regulatory arbitrage where they were very small, with very small capital, supposed to take micro deposits and make micro loans. They were really beginning to operate as banks and taking on risks that they should not be taken without the requisite governance systems in place, the capital in place. And the period at which they failed, coming on the back of us having to resolve the banks, the 9 large banks, meant that they were very systemic at the point of failure. Not originally thought to be systemic, but happened, there were just so many of them failing, and the contagion effect was just sort of building up. And so we had to really take very difficult steps. Now, the Banking Act also, beg your pardon, the Banking Act covers, the resolution powers there covers all deposit taking financial institutions. And so we were able to bring them under administrative resolution authority and very quickly resolve them. The problem was that while we had a resolution toolkit, we didn't have a deposit insurance scheme yet. There was an act that had been passed, in fact, the same day or maybe a day apart from the Banking Act. But the deposit protection scheme had not been operationalized to the point, and so there was nothing there. But everything was systemic at that point. And so unfortunately, the fiscal authorities had to step in to provide some taxpayer funding to take care of it. We were able to use tools for the banks, the P&A tools for the banks. For the smaller institutions, it was mostly a payout. Really, there were not many assets at all. So we did a liquidation process through receivers. So this is an example of one jurisdiction, for example, and many others with very strong resolution powers, but many that are host authorities that do not have these resolution authorities. And even some host or some home authorities lacking these very critical tools. There are also cross-border sort of intra-group holdings, which is another key crisis management issue, that cross-border crisis management issue that we see. A lot of these these subsidiaries rely on funding from group companies, but also the groups tend to borrow from the subsidiaries. And so it's very, very typical to see subsidiaries sort of transferring. So they call them placements. They're placing funds with a parent, right? And obviously outside the jurisdiction. In the event of a failure, how does one get their hands on those assets back into the jurisdiction? Very different legal systems and such. And then obviously with the claims of the parent on the books of the subsidiaries, one could, if they had a bailing tool, for example, the host authority could use a bailing tool to bail in. But the real issue of really using the bailing tool is also that the balance sheets of these banks tend to be more deposit based and with very little lending, no kind of TLAC related instruments. The only thing you might find is a placement from the group or from the parent, on the books. Yes, absolutely. So these are some of the issues. Now, in terms of cross-border crisis management cooperation arrangements, we do have, as Ignacio said not too long ago, we do have mostly sort of soft arrangements, supervisory colleges, MOUs for information sharing, sometimes joint supervisory action, in terms of inspections and all of that, a lot of information sharing. Supervisory colleges that mostly talk about prudential issues. So crisis management or resolution is really only now beginning to feature in discussions at supervisory colleges. And there's really no structured way in which that whole process is taken forward. We recently had the FSI, Ruth, again, was part of it, help us with a cross-border simulation exercise for 8 jurisdictions. And it was quite revealing. It's very, very interesting because we did not do well at all. These 8 jurisdictions, the key problem is that the host jurisdictions were frustrated with a parent jurisdiction in the simulation exercise that didn't appear to be able, in one breath says, well, we think we can resolve this at the group level. We're trying to get a group, we're trying to get a parent to mobilize some liquidity and push down to the subsidiaries. So you all stay still, we'll be back, but we haven't quite figured out how, but just wait, we'll get back to you very shortly. And we're like, well, the queues are forming up. You know, we cannot provide liquidity support. The institution is insolvent. Yeah, you're the only lifesaver. Are you coming on board or are you not? And how quickly? It was very frustrating. So we didn't like each other during the exercise. We didn't like how things went. And in the end, we all had to resort to doing it our own way, evidently. The one shocking aspect of it for us was that in the case study for the simulation, there was one of the 8 jurisdictions that didn't have, was a host jurisdiction, but not to a banking operation of the group, but to just shared infrastructure. So that entire jurisdiction.
Affected jurisdiction.
An affected jurisdiction. Well, it was affecting all of us because that's where the shared infrastructure was. And I bet you that the supervisors before hadn't thought of the possibility where you had a jurisdiction whose entire role was just infrastructure. And nobody had cared much about the operational risks relating to that. And so while you had distress conditions of the various subsidiaries and the group itself, the parent itself, the operational risks were also playing out around the same time, because this subsidiary that was providing the shared infrastructure also had some kind of a downtime, right? Suffered a downtime, and therefore access to infrastructure also became a problem. And that was quite interesting for us, that this is a jurisdiction that is affecting everyone in this group, but we hadn't previously thought about how would we deal with that in addition to distress conditions, right? You're dealing with capital, with insolvency, potential insolvency, but you're also dealing with a huge operational risk at this point. Anyway, so that was quite an eye opener. Fast forward, we're beginning to think through these issues more clearly. The Association of African Central Banks has itself set up a working group that is looking at cross-border crisis management. It's very early, you know, in its work, and so not much has been done. We're hoping that through the instrumentality of the FSI, at least the 8 jurisdictions that participated in the simulation can come up with some framework that perhaps can be shared across. And then, you know, basically it's important that every jurisdiction at least gets a resolution framework in place. And then learning from each other for those of us who've started and what the lessons have been, and how that could be replicated across is something that is important. I do not see major private law issues, given that a lot of these Pan-African banks and even the GSIBs operate through subsidiaries. So you don't have a situation where you have a branch in one country in a host jurisdiction dealing with sort of depositors in other countries and vice versa. What it is more, I believe, are the public law issues in terms of resolution powers, how to deal with non-systemic banks, what kind of framework to put them under. Like I said, in Ghana, they all come under one framework, and we have different tools to use for different ones. Some of the other countries, they use just a bank insolvency, a corporate insolvency proceeding, and coordination of activities across whether we're going to do a single point of entry, if that's possible, or a multiple point of entry, but not in a chaotic manner, at least to preserve some value group-wide. I think these are the more critical questions, but certainly issues of how do you get your hands on intra-group holdings, right? That's a critical one. And I think I'll leave it there for now. Thank you.
No, just to perhaps to facilitate the few minutes we have for discussion, two practical examples which we identified as impediments that we could find in a cross-border scenario to implement resolution measures, for example. The mobility of collateral between different jurisdictions, that was very clearly an issue. Or for example, the implementation of the bail-in rule, that's perhaps the most tortuous one. So think, for example, securities that need to be bailed in, which are listed and quoted in markets in two different countries. You need to coordinate the authorities in both countries, and that's a very complicated thing. So unless there's some sort of shared structure to implement those decisions, things are very complicated. Just two real life examples of what would be.
Well, Elsie, thank you very much indeed. That was very illuminating and interesting, I must say. We have Janice knows we're overrunning, eating, as it were, into her time, because I was a little bit nervous about that. But there'd been a diplomatic exchange between Janice and Ignacio, and that solved that particular problem. But we are coming close to our extended time, and we might have an opportunity for a question or two. Can we see if there are any in the room or online? I don't know who can look online to see if there's, we might try and give preference to someone online, but we have a question. Is there anyone putting a hand up online? Do we know? No. So do we have a question in the room? Or we've exhausted you all?
John Rios from the
Single please. Yes, sorry. Yes, do you want to just introduce? Oh, you need a microphone. Yeah, yes, there we go. Yes, sorry, of course you do.
Yeah, many thanks. Good morning, everyone. I'm Joan Rios from the legal department of the SB. And I wanted to maybe address, I thought it was extremely visual and graphic, what you were explaining, Elsie, on the difficulties when it comes to resolution in such a scatter scenario that you were describing. That evoked, nevertheless, my previous life before resolution and going more on the prudential codification situation, and whether one of the lessons learned that you may have had after that is that to put the emphasis also at the beginning, when you authorize the structures, when you set up your requirements in terms of prudential supervision, whether you measure the capacity in terms of effectiveness and enforcement of the rules, whether the balance between prudential and resolution is the right one in terms of coherence in the legal framework. I would like to hear your views on that. Thanks.
Thank you very much for that question. You're absolutely right. I think it always starts from the licensing stage. First and foremost, how many institutions should the licensing authority license? And in the case of the savings and loans and microfinance companies, I think that we license too many to start with, over and above our capacity to supervise, right? And I think that's number one. And then you set up for group companies, you've got to set up very clear requirements in terms of access to cooperation arrangements with home supervisory authorities, right? MOUs in place already, your ability to be able to understand what's happening group wide, right? So all of those are very important, and the reporting also from the subsidiary in terms of what's going on at the group, in terms and including shared infrastructure and all of that. So yes, I think that if you're doing licensing right, if you're doing supervision right, as always, you reduce the risk of failure even, and that if failure occurs, you're better able, if you've done your resolution planning also ahead and your crisis preparedness ahead, if even inevitable happens, you're better able to contain the situation and manage it. But it doesn't start from there. It really starts up front. Thanks.
I think probably we are now out of time. Do you think? I think so. Yeah, I think so. Janice is nodding. Can I say I think that we really have heard a number of very different perspectives this morning, and I think it's been really valuable from all our speakers. And I'm looking down here, but I'm also looking at Sumant, who I hope is also on the screen. I think it's extremely illuminating to hear these different perspectives and the problems which everyone faces, which may be a bit different in different regions, and how problems may be worked around in the absence of the formal tools which ideally you would like, and in which in time you will have. Not, of course, the tools provide the panacea. I mean, you know, each toolkit will reveal new toolkits which are needed. But I'm very grateful indeed for the contributions of everyone this morning, and I'd just like you to join with me in thanking them.
So just while we're changing panels, to remind you, there's water at the back there, and then after this panel, there will be coffee. If I can ask everyone to take a seat. I know the temptation is to start discussing what we all have just heard, but bear with us for this next important panel, and then we'll have that opportunity. So it gives me, I'm just very honored to be chairing this panel of very, very distinguished scholars and others. To my immediate right is Professor Irit Mevrek, who is the Professor of International Commercial Law at Warwood Law School in the United Kingdom. Professor Rosa Lastra, who holds the Sir John Lubick Chair in Banking Law, Queen Mary University of London. Online will be Professor Hideki Kanda, who is Emeritus Professor, University of Tokyo. And then last but certainly not least, Dr. Riz Mokal, who is a barrister, South Square, London, UK, and who was for many years also a professor, was how we knew each other as colleagues for many years. So with that, I'm just going to turn it over to Irit to commence.
Does it work? Yeah. Thanks very much. So thank you, Janice, and thank you, UNIDRA and the III, International Insurance Institute, and other co-sponsors, co-hosts of this symposium. And thank you for participating both in person and online. We hope to have further discussion after this series of short presentations in which we want to discuss further the idea of potentially developing a model law for cross-border resolution of financial institutions. And just to say that by cross-border resolution, we mean something broader than just hosting subsidiaries or branches. we mean that the host jurisdiction could host anything. So subsidiaries, branches, assets, creditors, infrastructures. So cross-border broadly defined, and also resolution is broadly defined. So in the sense of resolving the distress of the financial institutions by whatever tools most efficient and proper for the circumstances. So that includes also liquidation tools. So specifically, I will start the sort of setting the scene of this discussion about this concept of developing a model law by asking whether we need another international instrument for financial institutions in distress in light of what we already have out there. And then what sort of international instrument, and I will highlight the potential benefit of an international model law, and then also propose what could that model law look like? What are the key potential features of that model law and how it may operate in practice? And when I say I, or so I suggest, I ask, I actually mean we, because this presentation is based on that book on financial institution in distress recognition. So I actually mean the co-authors rather than just myself. The first question is whether there is a gap in the current financial infrastructure concerning international financial institutions in distress in view of the existing instruments. And Monica, in the first panel, explained that a lot has been done, especially since the global financial crisis of 2008, in terms of developing international instruments. And primarily, we see that in the key attributes, which is now the international standard for dealing with financial institutions in distress, especially the systemic ones. And those instruments also include cross-border aspects. And we see also the development of contractual solutions in the form of ISDA protocols, memorandum of understandings, and also hopefully additional guidance that will come from the UNIDROIT working group on bank liquidation, which will focus on liquidation and on banks which are not systemic. And we also see that in the business sphere, we have a range of model laws, so a system of model laws. Initially, the model on cross-border insolvency of 97, and then additional new model laws from 2018 and 2019 dealing with the recognition and enforcement of insolvency-related judgments and with enterprise groups. So there is a lot out there already, but still we argue that there is a gap, there is something missing in the context of financial institutions in distress. And we see that when we look at countries' systems, legal systems related to resolution and to the private international law of resolution, the cross-border aspect of resolution, or we look at surveys of countries responding to questions regarding what they have in terms of cross-border cooperation, recognition, and dealing generally with cross-border cases involving financial institutions. And financial institutions are also broadly defined here to include banks, insurance companies. So what we see from those surveys, from looking at country laws, is significant divergence, especially regarding the private international aspects, and often lack of rules, so nothing. In many countries, there is very little in terms of private international rules concerning financial institutions in distress. We also see that when we look at those existing instruments, the key attributes, the FSB principles, the MOUs, the ISDA protocols, we see that in terms of the way they are formed, either as high-level attributes or principles or as just contractual solutions, that means significant limitation in the ability to create something which is sufficiently uniform, especially if we look into the private international or cross-border aspects. Or also in terms of their scope, we see limitation in terms of the coverage of the different private international aspects. Often the focus is just on cooperation, recognition, and support, or just on recognition of certain contractual mechanisms. And then we also see that when we compare what we have for financial institutions with the model law system, which is primarily designed for businesses, we see that the model law system, and in particular the 97 model on cross-border insolvency, is quite comprehensive, did create a uniform framework, an actual framework for dealing with cross-border insolvency cases, which still has gaps, but it is quite comprehensive. and changed the world of cross-border insolvency since 1997 or the mid-2000s, when actually significant countries started to adopt it. But even though it could apply to banks to some extent, it is designed primarily for businesses, and it also sort of indicate to countries that they may exclude banks, financial institutions from the scope of those model laws, because there may be some special reasons for doing that. And indeed, many countries exclude banks and financial institutions from those model laws. So we do need that level of, that doesn't, this is stuck, I think. So if you can move to the next slide. Ah, it is, sorry. Yeah. So we do need that level of uniformity also for financial institutions, and especially regarding the private international aspects, because for private international rules like jurisdiction, applicable law, recognition, cooperation, relief to work effectively requires that there is significant resemblance between those rules. This is the essence of private international law, to create bridges among legal systems and to allow dispute resolutions or cross-border insolvency cases to operate effectively, even if the laws themselves are different. And this is why we see in these areas significant amount of conventions, regulation on commercial and civil law aspects. So harmonization of the private international law rules in the context of resolution is really important. We need an actual framework that can create that level of uniformity. But we also argue that in the context of financial institutions, we need some top-down, what we call top-down harmonization also of the tools themselves, the substantive laws, the resolution tools. Remember, resolution broadly defined, because this is where we see also absence of rules in legal systems. So compared with corporate insolvency, where the model laws could actually rely on the fact that countries tend to have those basic insolvency tools, stay, avoidance, voting mechanisms, restructurings. In the context of resolution, we also have, the laws are quite sophisticated and often newer, and there is less experience as well, because financial institutions cases of distress are more rare, but when they happen, they are quite dramatic and devastating. And so we need to make sure that we have some minimal basic tools in legal systems for a cross-border framework to operate effectively. And this little thingy circle is meant to remind us of the link between those two aspects, even though we are talking about two independent issues, so the harmonization of the private international rules and the harmonization of the resolution tools. They are interconnected in the sense that the more the resolution tools are harmonized, at least to some extent, the easier it is to invoke the private international rules, so to recognize, to cooperate, and vice versa. The more the private international framework works effectively, we will see more coordinated cases, so better experiences of using the tools across borders. And so countries can learn from that experience, develop those tools, and that generally promote a harmonization in this area. So we argue that we do need an instrument that can create that level of uniformity, a framework which is uniform primarily in terms of the private international rules, but to some extent also have some harmonized resolution tools, and the framework and instrument that is based on, that is reflecting what we call modified universalism. So modified not in the sense that this is a compromise with territorialism, but in the sense that it enables optimal solutions that are modified to fit in different circumstances, different type of financial institutions, different types of distress situations. And it enables a global approach to the multinational distress of the financial institution, optimal levels of cooperation and centralization, deference to a home jurisdiction, but also taking into account local concerns in the relevant circumstances. And in view of the need for such level of uniformity and the level of universalism, even if it is modified, we can start appreciating, I think, the benefit of a model law as the international instrument that we may want to choose. And this is because to achieve a level of uniformity and to achieve a level of universalism, even if it is modified, is difficult for countries because it is often perceived as, to some extent, threatening state sovereignty, deferring to a home country decision-making, resolution tools that may be applied, even though rationally thinking, ultimately, such solutions will be most efficient and most beneficial for the stakeholders involved. Still, it is difficult. And therefore, doing so through an instrument that is to some extent soft, in the sense that it is elastic, in the sense that it is softer than a treaty, it is softer than regulation which apply directly, can be easier. And at the same time, the model law as an international instrument form is not as soft as high-level principles or attributes or guidance. So it can provide that level of uniform framework that could be quite comprehensive and concrete, but still to some extent flexible and encourage negotiation. Still, I mean, we're not trying to underplay the difficulty, the challenge in achieving this type of model law. It does require persuasion. It does require that an international organization take that on board and receive that mandate and then start the process. But we think that if that happens, then it is very likely that through that process, eventually we can come up with a model law that can be a very effective and helpful type of instrument. And then, of course, we will need to see countries adopting that model law, and often we are skeptic about the possibility of persuading countries to do so. But again, we can be encouraged by what happened in the business sphere, where that same level of skepticism applied in that context as well. But we have seen, primarily with the model on cross-border insolvency, that in the last 2 decades, almost 60 countries, maybe it's a bit more than 60 now, have adopted it, and it's still ongoing. And as I said, it changed the world of cross-border insolvency cases around the world. Just to note that we are aware that there are different types of model laws out there. If we look at the work of Ancestral, for example, a different working group used model laws in slightly different ways. And so just to, again, sort of highlight what we mean by a model law, we mean a model law that is designed as law, so it is easy to adopt it, to enact it in legal systems. And as Ignacio said before, once it is enacted, it becomes law and it is binding. And we mean a model law that reflects the norm of modified universalism and that is aligned with the existing instruments that I've mentioned before, and primarily with the key attributes, because this is the international standard. And the whole idea is to promote harmonization rather than disrupt what is already out there. And a model law that is focused, that is designed, that is tailored for financial institutions. It isn't an afterthought in a model law that is primarily designed for businesses, but it is one where we address the unique circumstances of financial institutions. And as I said at the beginning, financial institutions broadly defined in terms of including banks, insurance companies, and different sizes of banks and financial institutions. So from the small to the very large, as I think Ignacio mentioned at the beginning, also the smaller sized financial institutions will have a cross-border aspects, so systemic, non-systemic, and that also is very context depending. So a comprehensive model law that will address the range of private international aspects, not just cooperation, not just recognition, and also include some resolution tools that we can identify as best practice. And here we suggest that there may be some greater modularity, so to accommodate the different circumstances of countries and the obstacles. I think Vivian explained really well the fact that we need to be aware of local obstacles when we suggest that you need to implement this or that domestic applicable tool. Now, I included here a couple of tables that I've copied from the book, just to give a sense of what we think a future model law could look like. So one table focuses on home jurisdictions, and the next table will focus on host jurisdictions, host broadly defined, branches, subsidiaries, other aspects. And we can see that we do envisage the recognition aspect is at the core of a future model law, but the model law will include the range of private international aspects, so jurisdiction to help identify the home country, and both in the context of a single financial institution and a group of financial institutions or part of a group, depending on the circumstances. So to identify the home jurisdiction, and then also rules on the applicable law and on cooperation, recognition, support, relief, enforcement. So to cover the range of private international aspects, and also to suggest, we see that in the middle column, the resolution laws, measures, tools that you may also adopt as part of the adoption process of an international model law. We can also see that we try to reflect here the norm of modified universalism, in that centralization, deference to the home jurisdiction is the default rule, the default approach, but this takes place while imposing duties on the home jurisdiction and requiring that they provide the notices, and they allow participation of relevant host jurisdiction in the decision-making process. We also see that there are exceptions to that deference to the home country decision-making and oversight of the entire process. There are some modifications to that, in the sense that host countries may open additional proceedings. It may be more efficient in the circumstances. So that does depend on the circumstances, in which case we will need also cooperation and coordination. And we see that recognition support is also subject to a range of uniform safeguards. I also included here, and again, this is taken from the book, one example, hypothetical example. We actually included a whole part in the book with a range of examples, which we initially used to just test ourselves, to test our idea of a model, or to see whether it works in the range of examples that we could look at. And so this is just one. I think it's the first one that appeared in that part. And so in this example, we have a bank incorporated and licensed in one jurisdiction, in Albania, and then that bank has a subsidiary in another country, in Mauritania. So the subsidiary is called Junior, and the bank is in financial difficulties, and they consider, in the parent jurisdiction, they consider what tools to impose, and they decide to remove all the members of the board, both from the parent and from the subsidiary. The subsidiary is reluctant, the authorities of the host jurisdiction are reluctant to comply with that, and the subsidiary is still solvent. And we are asking, so there's one missing slide. At the end, there were a set of questions where we were asking whether the host jurisdiction is likely to recognize those measures employed by the home jurisdiction, and what steps are required in this process, and what will happen also if the host jurisdiction doesn't have this type of measure in its legal system. And I'm sorry that this sounds a little bit like an exam question, but very, very briefly, and then Rosa and Idiki will actually talk about real life examples, which will be more interesting. But just to say that if those countries adopt the model law that we are envisaging, the idea is that the subsidiary, the host resolution authority, will need to recognize the measures that are taken on board by the parent authority, but this is subject to cooperation, including ex-ante cooperation and participation in the decision making. And so it is likely that actually through that participation, the authority, the home authority, will consider measures that can actually also work in the subsidiary jurisdiction. And so it may not be that measure that we are actually mentioning here, but just the fact that the host jurisdiction doesn't have in its legal system that type of measure doesn't mean that the safeguards apply, that the subsidiary authority can invoke the safeguards and avoid recognition. Rather, they are supposed to support those measures through something equivalent in the host country legal system. And this is also aligned with the key attributes, which require that resolution measures are given support swiftly through equivalent tools that are available locally. Over to you, Rosa.
Thank you very much. Sorry? Just in this direction. Okay. I'll try to do that. Remember, as I speak, let me start by thanking UNIDRA and evoking the memory of Professor Alberto Maccioni as founding president, together with Sir Roy Good, of the UNIDRA Queen Mary Institute of Transnational Law, which is co-sponsor of this event and which I have the honor of co-chairing together with Ana Venezia. I have advocated the need for a legal instrument to deal with the distress and resolution of financial institutions on a cross-border basis for a very long time. In 2006, Mike Kriminger, which was then General Counsel of the FDIC, and Eva Hoops set up an informal group in Basel. And this informal group, self-imposed mandate, because it was just a voluntary group, was to start coming up with rules, both private international law as well as substantive rules, on cross-border resolution of financial institutions. The group, founded in 2006, became a formal group of under Basel in 2007, December 2007, because of course we had the collapse of Northern Rock. And then this theoretical, hypothetical need of cross-border rules became a reality. We were going to need those rules. So it was a great deal of foresight. But I remember that in our discussions in 2006 and 2007, before Northern Rock, it really appeared as a very distant possibility that an international consensus could be reached among jurisdictions on the insolvency of banks, cross-border insolvency of banks and other financial institutions, given the lack of convergence, the differences in private law, the inconsistencies in the legal framework. So this all seemed like a dream, something that it will take a very long time. Also, I must say, at the level of the EU. In 2011, I edited a book on cross-border bank insolvency before actually the adoption of the key attributes. So that's why I still refer to bank insolvency, because the term resolution, which is now a term of art, was still not adopted. Resolution was at a term at the end of the supervisory spectrum, just before insolvency, but also pre-insolvency, sometimes insolvency. So it was very confusing at that time when it first appeared. We are now having much clearer guidelines, particularly with the tools that we have in order to understand what that instrument could be. And again, in that book, there is a concluding chapter in which I advocate the need for a treaty. The scope of the treaty in a way relates to some of the scope of the model law. And I do acknowledge the difficulties. I'm still a dreamer and I still believe in the opportunity for cross-border cooperations and international initiatives. So I still think it might be possible, even desirable in the near future. But for the time being, we live in an imperfect world. And what seems much more realistic is what Edith and her distinguished co-authors and many dear friends are putting together in this book. So in a way, my presentation is also an endorsement of why we need clear and predictable rules that add certainty to what is a very fluid field. But my remarks today focus on a case which I know relatively well because I was the expert witness for the Kingdom of Spain, advising both the Banco de España and FROB in the Banco Popular arbitration. And the Banco Popular case, the Banco Popular resolution, is a fascinating case that offers in practice the fluidity of what the distress implies. First, because it evidences the interlinkages between the various crisis management instruments at the time of tectonic changes in this area. In this case, of course, it was Spanish bank supervised by the single supervisory mechanism, by the ECB, following the transfer of sovereign powers in the area of prudential supervision on the basis of Article 127.6 of the treaty. But that was a tectonic change that was not fully understood by many of the aggrieved shareholders, aggrieved creditors, aggrieved investors in general. And the other tectonic change was, of course, the incorporation into hard law of the soft law that the key attributes had been. The soft law became hard law with the Bank Recovery and Resolution Directive and the Single Resolution Mechanism regulation. So the dynamics of the Banco Popular in this tectonic change illustrate very well the fluidity and the need for clarity in this field. For not only for the authorities, and if I may talk on the side of the authorities, to the extent I have sometimes advised them, may I say we, investors, creditors, they need to know what's going on. They need to know about these tectonic changes. And secondly, the novelty of this regulatory framework, which combine the incorporation of the key attributes and the transfer of sovereign responsibilities in the case of the European Union with the euro area, leading to a multi-level governance, led actually to very inefficient multi-pronged litigation and arbitration. And this is another reason why we need a model law eventually, because there were claims brought before the Single Resolution Board Appeals Panel, which are administrative procedures, simultaneously with litigation in national courts, the Audiencia Nacional, simultaneously with cases, many cases brought in front of the Court of Justice of the European Union, and this is perhaps the case I know better, and through the lens of the arbitration, which obviously I'm not talking about anything private, everything is in the public domain because the final award was published on the 23rd of March of 2023. But again, this arbitration again shows how these tectonic plays were not fully understood. It also helps me to explain a little bit the incompleteness of banking union. Today, UNIDROIT is having this wonderful conference at the same time as the Banco d'Italia is having the 10th anniversary of the SSM. I was conflicted, but of course I would come to UNIDROIT. And then it also helps to understand the gap. So I'm not going to talk so much about the gap until the end of my presentation, but clearly we need cross-border rules, if of a hard law nature, of a soft law nature, of any nature, that add greater predictability and certainty in this fluid situation in which sometimes investors are not fully aware of the changes that have happened. We also need rules, and this is a particular field in which I have been doing research and advocacy for a very long time now. We also need clear rules on ELA, Emergency Liquidity Assistance, on lender of last resort, and I'm going to explain. Before doing so, I go now to the substantive level. I said about the fluidity of a bank crisis. So when we talk about the scope of bank crisis management, so what actually does it mean to deal with a financial institution, in this case a bank, and I will leave aside insurance companies and focus on banks. As regards the official responses, and incidentally, those that promote market discipline, they should also promote private responses in terms of protection, like in the case of LTCM and some of the lifeboat operations. We need also private responses. But when confronted with a failing bank, and I'm not going to go into the technicalities of what we have been discussing, fascinating discussions in the last 3 days, ongoing concern versus gone concern. But let's call it, just for the purposes of simplicity, in a way that also extends to other jurisdictions in Latin America, Africa, failing and failed banks. Public authorities have at their disposal, one, the lender of last resort role of the central bank. This is actually the very first line of defense that is in any crisis. And that has to do for a number of reasons. One, because the immediacy of the assistance can be provided on a discretionary basis once that the requirements are fulfilled on a very short-term basis without any of the further legal requirements that obviously we need to start and apply both resolution tools as well as special bank insolvency when there is a lex specialis in bank insolvency. So So thank you. We were here. No, we are still. No, we are in the previous one. So the second one is deposit insurance or guarantee schemes. So again, we have had a lot of discussion, very important, and I will not go more into that. 3, we have government policies of implicit protection of depositors, banks, the too big to fail doctrine and its variants, too interconnected to fail, too important, too important to jail, too important to close. There are many, many variants, and also the payment system. These, of course, come into play sometimes simultaneously if all of a sudden, or a special legislation that is adopted on an emergency basis, if all of a sudden one realizes, the authorities, that the tools to which Lord Richards was referring were not enough. When you don't have sufficient tools, then you have to immediately either do emergency legislation or just de facto do an announcement that all deposits will be protected, as indeed happened in Northern Rock, because we had bank runs, not only, you don't only have bank runs in Africa and Latin America, runs in London, and for what effectively was not a systemic ban, not a systemic ban. Again, the idea that Lord Richards referred to. Then we have resolution and insolvency, of which in this group know so much, and of which we have now this very interesting working group that will be available, the legislative guide, both for single track jurisdictions, those that apply the same regime for resolution and liquidation, and for dual track regimes in which you have a different regime for a resolution and liquidation, depending sometimes on the size, sometimes on the significance. The difference is not always so clear, and it's also a fluidity there. And then we have the early intervention measures, the recovery, but also other preventive measures that sometimes prompt corrective action in the US that include enhanced supervision that is already crisis management, because supervision at the end of the supervisory spectrum meets with crisis management. So we have, this is the actual scope of bank crisis management, and the fluidity of these instruments is not that they're sometimes sequential. Sometimes you have parallel way of application of them. And so this is what we also need to understand when we talk about the importance in future of a model law and what it is that substantially needs to be happened. So the reflection on the UNIDRA working group on bank insolvency is not, obviously, it appears a bit self-serving, but our work is incredibly important. It will really serve as a proper guide in an area in which we have immense gaps. I will not elaborate because I'm realizing that I have a few slides to cover. The nature of systemic risk is very fluid, and I think the lessons from the Silicon Valley Bank indicate the fluidity of systemic risk and how an institution that is first not considered to be under the regulatory of significant credit institutions can actually become significant. And you do not know ex ante, you know ex post, you know when you're already in a crisis management situation. So just very briefly, in the European Banking Union, I said that the Banco Popular arbitration, or the Banco Popular case, showed two tectonic plates taken together at the same time, of which there was perhaps not fully awareness. One is that banking union was already there. We had single supervisory mechanism. We had single resolution mechanism. And that has been confirmed by the Court of Justice of the European Union in the Berlusconi case, ICRE and others, that the responsibility has been transferred to the supranational level for the significant credit institutions. And I will not enter into the complex world of the non-significant credit institutions. But we have a relatively well-functioning SSM, relatively well-functioning SRM. We do not have a fiscal backstop other than the ESM, but it's a limited fiscal backstop. We have the Single Resolution Fund, which is being beefed up and will be continued to beefed up. We do not have single deposit guarantee scheme. We do not have EDIs. So we have, again, an incomplete building. But we have the elephant in the room is that we do not have emergency liquidity assistance, lender of last resort. And I'm going to explain why and what the lessons were in the case also of the Banco Popular arbitration, and why emergency liquidity assistance merges private law and public. And is therefore important to understand how a potential instrument in future can deal with those things. So just we all know the specialty of banks, and this has been part of our discussion in the working group. Perhaps just in the context of what I'm going to explain next, let me say that not only banks have a special role in the economy, in the payment system, the nature of supervision and regulation, the nature of crisis management, the fact that all non-viable banks or part of any jurisdiction financial safety net, regardless of size, and that corporate insolvency regimes, as it very well reminded us, are not designed to address the particular risk and public interest concerns that arise when a bank fails, perhaps ex post, not necessarily ex ante with a small bank. I'll just say that banks have also a special role in the transmission of monetary policy and in lender of last resort. Only the commercial banks keep reserves at the central bank. And because of decentralization of reserves, the central bank can act as lender of last resort and conduct monetary policy operations. This is sometimes a point. It's not just the monetary rationale of bank deposits, which we all know in the UK bank deposits. I haven't checked the latest figures, but was 97% of the money in circulation under what is called M1, and only 3% is actually the cash and the reserves. So we all know the specialty of banks, so let me take it as a granted in this very distinguished group. But sometimes what is less well known is how lender of last resort operates. And there is often amongst lawyers and judges a degree of deference to the discretion of central bankers when we come to matters of lender of last resort, as well as monetary policy, though in the ECB is different. The Court of Justice of the European Union has early come definitely in terms of monetary policy, but let me say that these issues, monetary policy, of course, has distributional effects, which from a legal perspective are very important, and they also have potential extraterritorial effects, as the monetary policy of the US reminds us all the time. But so that this decision to serve as lender of last resort can be taken on an individual basis, which is often referred as the credit approach, or on a market-wide basis, which is referred to as the monetary approach via open market operations, QE. And in the case of the ECB, which was obviously the one to which the Banco Popular arbitration case was particularly relevant, there is a bifurcation of responsibilities. And this bifurcation of responsibilities is that the ECB, the European Central Bank, is in charge of the ECB is in charge of the monetary approach, is in charge of the provision of liquidity to the market, whether it is long-term refinancing operations and many others. Again, I'm not going to go. But the decision to act as a provider of emergency liquidity to illiquid but solvent banks on the basis of adequate collateral is a responsibility that belongs still to the national central banks. And this is because of a restrictive interpretation of the executive board of the ECB in 1999 that decided that according to Article 14.4 of the ECB statute, and I'm not going to bother you with the details, the responsibility for providing emergency liquidity assistance on this basis remain a national competence. This might have made some sense when the European Central Bank was created, because the supervisor was still the national authorities. And if you supervise institutions on a sunny day, then you can provide them liquidity on a rainy day, even taking the analogy of liquidity to its greater level. But it was not done. I argue that now that we have supervision has been transferred to the supranational level, the national central banks do no longer have the capacity to authorize the issue of notes, a very big issue these days with the advent of CBDCs. They do not have that capacity. That is a prerogative of the European Central Bank, and is also a transfer that has been, a competence that has been transferred monetary policy. It doesn't make sense to continue to have lender of last resort. This, of course, is very different from the case of a currency board, in which the currency board will not have the ability to do monetary policy. So the sui generis, let me go backwards. The sui generis nature of ELA in the euro area, which I just explained to you, was this tectonic change that meant that when the Banco Popular was given emergency liquidity assistance by Banco de España, for the reason I have told you, So it had first gone to get liquidity via open market operations to the European Central Bank via monetary policy operations on the basis of adequate collateral, which is always of higher quality than the collateral that is available to emergency liquidity assistance under this particular sui generis understanding of ELA. So ELA in the euro area is not like lender of last resort generally. It has a very peculiar and particular understanding, which is constrained discretion, and I explain very briefly in the next slide. So the provision of emergency liquidity assistance was a task of the of the Banco de España as a national central bank. However, the supervision and the resolution were no longer in the hands of the national authorities. They had been transferred to the supranational level. And this really was at the core of the Banco Popular arbitration, both understanding the transfer of competences and, which perhaps was not fully understood by the investors and the advisors to the investors, and to understand the nature of emergency liquidity assistance. So on the 7th of June 2017, when the Single Resolution Board applied the resolution tool of the sale of business, in this case to Banco Santander, it was applying the regime which was already legally mandatory. No other regime was available in Spain. No other regime was available for Banco Popular. But what happened is that, however, you still had the provision of emergency liquidity assistance at the national level. And then there is, obviously, the case is a bit more complicated, but I've learned it always happens in arbitration. The cases become more complicated. Just to give you a very brief understanding, so ELA is, I said, is provision of emergency liquidity assistance to illiquid but solvent institutions. That's generally lender of last resort. But then it's also discretionary. So it's not mandatory. So no institution is actually entitled to receive lender of last resort from a central. But ELA in the euro area is also constrained discretion, a term that sometimes has other variants. So this discretionary power that that the Banco de España has is subject to again a bifurcation of EU law plus ECB law and national law. The bifurcation is that it needs to comply with Article 18 of the statute, with the basis of adequate collateral, any credit operation, the objectives and tasks of the ECB. And once that it goes above a certain limit, which is 2 billion euros, sorry, no million. 2 million is nothing these days. Well, nothing. For me, it will be a lot, but anyway. Certainly not in this context. Then you need the governing council has to actually give the non-objection. This goes back to the primary law. Prohibition of monetary financing, which in the EU is very important, and was also playing a key role here, because if the assistance, and this is where the line between illiquidity and insolvency is a fine line, if the assistance is to an insolvent institution, then you're incurring into another legal framework, state aid, monetary financing, and then infringement of no bailout clause and other things. And then we have also, just to make things more complicated, the ECB, because of this non-objection, has constantly been first non-publishing and then publishing guidelines, which they call ELA agreement, ELA procedures, for a very long time, from 1999 to 2013. These procedures were not published, in line with what happens with other many central banks in the world, including the Bank of England, which only started to publish the famous Red Book and that following the global financial crisis. Up until then, the rules of lender of last resort were not subject to a normative framework other than the contractual framework, the existence of collateral. So let me move to my right-hand side, the national law requirements, so the collateral rules. ELA can only be dispersed under EU law very clearly by all the Commission communications, by the ELA procedures, by the primary law, can only be disbursed if it is secure against sufficient collateral, which is of a lower level than the eligible collateral that is available for monetary policy operations, which will be and was the first port of call of Banco Popular when it needed liquidity assistance. So indeed, when it went to ELA, it was already a desperate situation, not only because of the bank mismanagement, which I'm not going to discuss. It was a desperate situation. And what collateral does? So no collateral, no lending, would say a national central bank, rightly so. Why? Because collateral protects the national central bank against the risk that if the counterparty defaults on the underlying assets, the loss accrue entirely to the national central bank, in this case, to the Spanish taxpayers, to the Spanish authorities. They will not be shared among, so monetary policy operations are shared, according, I'm not going to explain the formula, but they're shared. But for the national central bank, they're not shared. So no collateral, no lending, because it's the use of public funds. The risk of loss is to the fisco, to the public authorities. And then there is also the ELA contracts. I'm not going to get into that other than to say that the ELA contracts, and again, this, I would encourage you to go to read paragraph 612 of the arbitral award, because it's the absolute best description that you will ever find on a normative, not normative, because this is not normative, this is an arbitral award, anywhere, of how actually it works, step by step. And this is how actually it works. That's how it works in the euro area. In other jurisdictions, it works on a similar basis. You still need. So there is, for instance, I have never seen in a legal text ELA contract. And so you have the ELA request, the solvency assessment. You can see how it moves. No, ELA request by Banco Popular, solvency assessment by ECB, identification of potential collateral first by Banco Popular. It's also what is called the dry runs, to which the arbitral award also refers to. Determination of haircuts and maximum amount of potential ELA by Banco de España. Thank you very much. Non-objection ELA contract, pledging the collateral validly and legally, disbursement request by Banco Popular, and then ELA disbursement by Banco de España until there was no more disbursement. That time frame, which is very well described in the award, I'm not going to go, has to do with the declaration of failing or likely to fail. Once that the declaration of failing or likely to fail takes place, obviously you cannot continue to provide ELA because the institution is placed under resolution. Under EU law, we have a very complex, incomplete, imperfect, but legally binding system of what we consider to be failing or likely to fail, which is less good, in my opinion, than the point of non-viability of the key attributes. But the law is what the law says, and the law is what the law has to apply. So, you know, the bank has to be failing or likely to fail. There should be no supervisory or private sector measures that can restore the bank to viability. The resolution should be necessary in the public interest. The public interest. The public interest bifurcates into the national insolvency law and the resolution. Just to say that the public interest assessment is currently under discussion under the CMDI, under the Crisis Management and Deposit Insurance. I will not go, the failing likely to fail criterion includes everything: insolvency, liquidity, use of public funds, and the requirement to continue to be authorized as a public institution. So I said that when supervision was at the national level, it made sense. It no longer makes sense. This is not even dealt with or mentioned in the CMDA framework. We need to have a congruency of control, responsibility, and liability, which at the moment we don't really have in the banking union. And then the lessons for the model law, if any lessons. One is the fluidity and interlinkages between crisis management instruments, not just the resolution, but just these crisis management instruments. The other is the need for harmonization of the assessment, capital and liquidity, not only the resolution tools, but also the assessment of the liquidity and solvency, particularly solvency. Then a cross-border framework needs, for the reasons I hopefully outlined in my presentation, I could go into further detail to include rules on ELA, lender of last resort, if only to establish adequate accountability. I always say if one doesn't want to include, at least establish accountability mechanisms. That's the default mechanism. And then the multi-level governance also shows how sometimes you can have different levels, national, supranational. And then the principle of judicial or procedural economy would suggest that the system we have, certainly in Europe, is very incomplete. We need also public education of the public and investors to understand how the system works. It's a complicated system, but it is what it is. So conclusion, just to endorse the model law, we need clear cross-border rules that add predictability and certainty in what is, by definition in practice, a fluid institution in a financial institution in distress. Thank you.
Thank you very much. Now, Professor Honda, I'm hoping we can pull up your visual. Let's see.
Yes.
There. Okay. All right.
Right.
So I think Isabel here has kindly agreed. Just say next slide and she will advance the slides for you.
All right. Thank you very much, Janice, and good morning from Tokyo. I'm sorry my participation is online today, but it's my great pleasure and honor to speak in this panel. And I would like to thank Janice, Ignacio, and the organizers. First of all, next slide, please. Thank you. First of all, I would like to express my warm congratulations on the publication of this book. The analysis in the book is comprehensive, deep, and sophisticated, and such the book is quite helpful. The book offers a model law approach. I think that it's a great fruit of teamwork by the authors. So indeed, what should I say in my presentation today? Next slide, please. Well, indeed, Edith and Rosa said all important points, and there is nothing left to me. I think I will do two things. Number one is that I will go back to the basics and present one basic theme or a theory in this area, and see how the model law approach in the book is useful and helpful. And second, I will show real examples. I'd like to show you two real examples from Japan. Next slide, please. Thank you. So my theme is on this slide. It's very simple, 2 dimensions. The horizontal axis or spectrum is regulators or supervisors or resolution authorities on the one hand and courts on the other. For simplicity, I use the word regulator today. I also use the word bank rather than financial institutions in my presentation today. The vertical axis or spectrum is statutes and contracts. The contracts here include both ex-ante and ex-post contracts. I must emphasize that in both axes, it should not be regulators versus courts or statutes versus contracts. It should not be one or the other, but it is a spectrum. So the key question is, of course, where the optimal combination of the two must be. Let me begin with regulators. One starting question, of course, is whether banks are special, outside insolvency, and inside insolvency, and whether a specialness, which generally justifies public regulation, is the same or not between outside and inside insolvency. I do not want to spend much time on this issue because Rosa's slide shows the details for bank specialness. But for simplicity, here I want to follow the most simple view by Matthias Duatripont and Jean Tirole. And they basically say that the depositors are dispersed and small, so a regulator is called for to represent them. Importantly, this view is valid both outside insolvency and inside insolvency. So outside insolvency or in normal situations, the regulator steps in even if the bank is not insolvent. When the bank becomes insolvent, the regulator continues to step in as a representative or special class of creditors, that is depositors. Other arguments are, of course, possible if you focus on systemic risk and so on. If you look at the horizontal axis or spectrum, both regulators and courts are involved in bank resolution. Regulators tend to act promptly, and regulators in different countries tend to cooperate, while courts tend to be slow and generally do not cooperate with the courts in other countries. Also, because banks lend until they fail, regulators tend to step in an early stage, while courts usually do not. Courts are passive, namely someone must file a petition for the court to act. Therefore, the question is, what is the optimal mix or a combination of regulator and court involvement? The answer seems to depend on many contingency in a given jurisdiction. A bit more complexity, I have to say, arises when it comes to two more issues. One is the timing issue of the relevant decision-making, and the other is how much power regulators should be given, in particular in cross-border bank resolution. As to the timing of decision-making, my sense is that for insolvency of business entities, not banks, decision-making itself generally is better delegated to private parties, but the timing issue may not be. In insolvency, decision-making often requires judicial approval or the like, but the role of the court should be limited to checking conflicts of interest or checking the last-minute misbehavior of the debtor or certain creditors. So what about in cross-border bank resolution? Well, unlike in the insolvency of business corporations, regulators are essential, or their involvement is unavoidable. And thus, when you speak of cooperation, and cross-border cooperation can and should take place both at the regulator's level and at the court level. You should note that regulators and the courts behave very differently. Once again, the courts are passive and regulators are active. Thus, while the UNSTR framework is generally very useful, I must emphasize this unique feature of regulator involvement in bank resolution. Regulators, act at ordinary times as well as bad times, so their activities at usual times are very important. Unless some sort of minimum harmonization of resolution rules exists among jurisdictions, regulators are difficult to cooperate at bad times. So in summary, we should note the difference between court-level cooperation and regulator-level cooperation, and we should show a vision of this two-tier structure of cooperation. To obtain a universal treatment, or one asset pool, so to speak, and fair treatment, there are a variety of hurdles, of course. International insolvency of business corporations assumes the involvement of the court only. In contrast, in some jurisdictions, bank resolutions take place under regulatory control and without court involvement. In many jurisdictions, court involvement is required by constitutional law or otherwise, for example, in order to wipe out existing shareholders and cut creditors' claims. Thus, even if regulators agree on coordination ex ante, they often need to be given legal power to proceed in accordance with such agreement. Very often, it requires not only legislation, but court involvement as well. Well, I also know that the legal certainty is very important. However, in addition, speed is very important in bank resolution. Bank assets deteriorate quickly. So now the vertical axis or spectrum. Legal and regulatory rules are provided by statutes. Well, generally, they must be clear, and if so, they increase ex ante legal certainty. However, our experience in bank resolution tells us that writing a complete rules and regulations by statute is not an easy task. This means that we need a contract approach to complement statutes. Ex ante contracts by the relevant parties may provide predictability, but again, our experience tells us that ex post contracts or agreements are sometimes called for. Very often in reality, multiple insolvency proceedings take place, and yet it is not impossible to pursue a certain degree of universal treatment if and only if the relevant parties, such as insolvency representatives, could agree on certain measures ex post. Put this point more generally, the issue is the optimal combination of statutory and contract approaches, and the contracts do not have to be limited to ex-ante contracts. Next slide, please. Now I want to show you two real examples in Japan. One is a failure of a large bank in Japan in 1998. The other is a court case which arose as a result of Lehman collapse in 2008. This is the first example. One of the largest cases in cross-border insolvency involving Japanese banks is the failure of a large bank called LTCB. It is called Long-Term Credit Bank. in 1998. And LTCB was a large international bank and failed in 1998. This bank's large derivative position with foreign and domestic counterparties led Japanese authorities to be concerned that the LTCB failure would pose a contagion risk to overseas financial markets. After lengthy diet debates in the summer of 1998, a special statute indeed was made as temporary legislation until March 2001. Under this regime, Japanese government decided to place this bank under temporary nationalization on 23rd of October in 1998. One of the legal questions indeed was a technical one, and that was whether or not temporary nationalization would constitute an event of default as set out in the ISDA-ISDA Master Agreement. Literally, the Master Agreement provided that the public management is an event of default. And what Japanese government did could be literally translated into English as special public management. It's called in Japanese, tokubetsu koteki kanri. However, what Japanese government did was nationalization, which was to take rescue measures. As such, there seems to be little reason for counterparties to apply the default clause and trigger close-up netting of the outstanding derivative contracts. Under the circumstances on 22nd of October 1998, from New York City, next slide, please, the ISDA issued a public statement to confirm and welcome what was done by the Japanese government. Next slide, please. Thank you very much. It's a bit difficult to look, but this is the press release. Thank you very much. As a result, market confusion as to the possible operation of the close-up netting provision was avoided. That is to say, no institutions or counterparties triggered close-up netting clause, and there were no major direct spillover effects on financial markets outside Japan. The second real example is shown on my next slide. So next slide, please. Probably one more next, please. It's much. Oh, yeah, next slide, please. Yes, thank you very much. The second example is the collapse of Lehman Brothers, indeed. Lehman Securities Japan was an entity in Japan and 100% subsidiaries of Lehman Brothers in the US. When Lehman US collapsed, Lehman Securities Japan collapsed as well. On 16th of September, the Lehman in US filed Chapter 11 15th, but 15th was on Sunday, and then September 16th was on Monday, and on that Monday of 2008, Lehman Securities Japan filed a petition before a Japanese court for an insolvency proceeding called rehabilitation proceeding in Japan, Japanese counterpart of US Chapter 11. Nomura Holdings, a bank holding company under the relevant banking regulations in Japan, has 200% subsidiaries. One is Nomura Securities here, which is the largest securities house in Japan. And the other is Nomura Trust Bank, a banking institutions on this slide. Both Nomura Securities and Nomura Bank had outstanding swap positions with Lehman Securities Japan, and upon the commencement of judicial insolvency proceedings of Lehman Securities Japan, all outstanding positions were terminated and close-out netting was operated. As a result, what happened? Well, Nomura Securities ended up having a claim of 1,710 million Japanese yen against Lehman Securities Japan, and Lehman Securities Japan had a claim of 430 million Japanese yen against Nomura Bank. Under the court-supervised insolvency proceeding, the insolvency representative of Lehman Securities Japan sued Nomura Bank for the payment of this 430 million Japanese yen. Well, Nomura Bank asserted that we would exercise a set of the above two obligations. Well, what happened? Well, both the first instance court, which is Tokyo District Court, and the second court, which is Tokyo High Court, did recognize this three-party set-off. But the Supreme Court of Japan reversed and denied such set-off. The Supreme Court said that the set-off is a two-party event under Japan's civil code, and the three-party set-off is not recognized and invalid under the relevant insolvency statutes in Japan. One more point about Japan. Move to the next slide, please. Next slide, please. Thank you very much. Oh. Next slide, please. One more. Thank you. Aside from these two examples, there is a statutory regime for bank resolution in Japan. That is, although there is no court case yet for big banks, Japan implemented FSB's key attributes and changed the relevant statute accordingly. Including this, the current regime in Japan covers G-SIBs, D-SIBs, and non-SIBs. So next slide, please. Next slide, please, perhaps. Yes, thank you very much. Now going back to my two-dimensional theme, where should the two examples I mentioned be located? In what quadrant? Well, I think the LTCB case is in the lower left quadrant, and the case of Lehman Securities Japan should be in the upper right quadrant. As I mentioned, there is a statutory regime for bank resolution. I think it should be located in the upper left quadrant. Now, if Japan implements a model law that is proposed in the book, how would the landscape change? Well, more generally, from a theoretical standpoint, what quadrant is the best? Well, I think the answer is it depends. It seems to me that what the authors propose in the book is not a model law itself, but a model law approach. The authors seem to be careful and modest. They propose a model law approach by specifying key guiding principles or key points. And the book suggests a harmonization of PIL, private international law rules, and at the same time, the book offers a list of key tools for cross-border resolution. To that extent, the book offers guidance on substantive law and regulation. I like the approach proposed in the book by very much. As a matter of substance, the authors envisage modified universalism on the basis of which they suggest the harmonization of PIL rules. In this way, legal certainty and ex-ante predictability are to be enhanced. The authors seem to emphasize that the model law should ensure fairness, but at the same time, again, speed is very important in bank resolution because bank assets deteriorate very quickly, so early intervention by the regulator is essential. So in my understanding, the book suggests a reasonable range of combination of regulator and court involvements and a reasonable range of the combination of statutory approach and contract approach. In other words, as far as substantive laws and regulations are concerned, reasonable people might disagree on one single law or regulation. Therefore, we must respect and recognize the position and the policy of each jurisdiction and should not or should find a way to coordinate different laws and regulations under modified universalism. For this to work, I think substantive laws and regulations in the relevant jurisdiction should be within a reasonable range, but the reality is not quite so. I thus welcome the book's approach and very much hope that the book will help a clear and reasonable legal regime be built up in the international legal community with the help of a model law. I stop here. Thank you very much.
Thank you very much, Professor Kanda, and I appreciate, technical challenges. I appreciate we're running a little bit late. We are going to turn to Riz now. We will take a 5-minute comfort break afterwards, but if you are absolutely desperate for coffee, you can slip out and slip back. So I'm turning over to Riz.
Thank you, Janice. My instructions are to take no more than 10 minutes. I'm now setting an alarm for 7 minutes. All of us will hear this alarm, and that will give me 30 to 45 seconds to start winding up. So we are all going to police me in making sure that we remain not too far behind the schedule. I want to take 6 minutes and 41 seconds to try to explain potentially the role of a model law in the heart of a systemic crisis. I'll draw on what has gone before. But my focus is on trying to show you how important it is to understand accurately how a systemic crisis may come about, how systemic risk may materialize into crisis, and what a model law may potentially do to mitigate the existence and the severity of such a crisis. Let me remind you of the traditional microprudence-based view of systemic risk and systemic crisis. The traditional view has been there are institutions, financial institutions, let's say banks, which are exposed to each other. They have lent to and borrowed from each other. And when one bank gets into difficulties, often conceptualized as extrinsic to anything that the bank's decision makers may have done, the difficulty or distress of this one bank transmits to its counterparties through the contractual relationships of lending and borrowing and other collateral giving, etc., which exist between the distressed bank and its counterparties, and dominoes start to fall. And so this is the domino conception of systemic risk and systemic crisis. There are two problems with this. It's theoretically wrong and it's empirically wrong. So theoretically wrong because central banks repeatedly tried to model the falling of dominoes. That is, they repeatedly tried to model how the collapse of one banking group or financial institution would transmit distress to its counterparties. They've never been able to show how this would happen, short of creating completely implausible scenarios. For example, in 2006, the Dutch central bank had to create a model based on the collapse of the entire aggregate European banking market in order to create within the model the domino effect for the Dutch banking system. So it was that sort of implausibility. And then if you look at how actual risk transmits through the system, take the example of Silicon Valley Bank, collapses on the 10th of March, Signature Bank, New York, 12th of March, First Republic, San Francisco, 1st of May, Heartland Tri-State, Kansas, 28th July. There aren't many linkages contractually between these two institutions. So how does it come about that there is this transmission of risk? In the following way. The first mechanism is information contagion. One manifestation of this is the wake-up call effect, so-called. What happens is that those invested in one institution look at the distress of another institution and treat that as a wake-up call. They think, is the institution to which I am exposed similar in relevant respects to the collapsed institution? And that happened in relation to Silicon Valley Bank, not because the bank was contractually linked to any others. But why did that crisis not flower into a major systemic crisis? It threatened to, but why not? One reason was that the deposit limit, the deposit protection was increased, so any limits were removed, and that was potentially very powerful. But the second was that there was no asset value contagion. Now, asset value contagion is the most important mechanism for getting systemic risk materializing into a systemic crisis. What happens is that an institution becomes distressed, it comes under pressure to gain liquidity. It seeks to do that by dumping financial assets that it holds into the market. The dumping of those assets lowers the value of those assets. Similar assets are being held by way of collateral or capital by other institutions. That creates pressures on those other institutions to post greater collateral or to raise more capital. They are unable to do that because we've just seen, ex hypothesi, that type of collateral is being dumped into the market by by the distressed institution, and that is the key mechanism by which a systemic risk flowers into a systemic crisis. And this asset value contagion has been recognized since the time of Irving Fisher in 1933 in the midst of the Great Depression. Professor Kanda mentioned long-term credit bank, which collapsed in 1998. It was recognized in the context of LTCB by a G10 report in 2001, Group of 10 report in 2001, that the operation of closeout netting arrangements that LTCB was going to bring about. Why? So as to try to dump collateral into the market in order to raise liquidity. That and the operation of these mechanisms by the counterparties to LTCB was going to, so that they could close out their contracts and dump collateral into the market as well. That was the mechanism by which LTCB could potentially have triggered a Japanese-wide systemic crisis. So what was required was something which could slow down the tendency of the counterparties to LTCB, the distressed institution, the tendency they had to try to protect individually, rationally, try to protect themselves, but by dumping financial assets into the market in a way which would then trigger a crisis. And so the mechanism used there was legislative intervention to ensure that closeout netting clauses were not binding. They were not mandatory anymore. I'm very amused in a bitter sort of way to see that ISDA welcomed this step by the Japanese legislator, because ISDA was key to going around. And if you look at the documents that they have put out, they were key to getting governments and legislators. So that's the end of my 7 minutes. So I'm going to now take 1 minute to wind up. So they were key in getting legislators to remove barriers to closeout netting and collateral disposals. So it was a bit rich of them to then turn up and say, we applaud the reversal of what we had persuaded the Japanese to do. We applaud the reversal of those mechanisms by the Japanese legislator. How would a model law help? Well, start with closeout netting. It is the case that after the lessons which had been learned after LTCB had been forgotten with ISDA's help over the intervening periods to Lehman's collapse. Lehman's collapse resulted through the operation of closeout netting clauses in what Judge Jim Peck, who was the New York judge dealing with Lehman's collapse, estimates was something like $30 billion of value through the operation of these mechanisms. The regulators relearned the importance of stopping asset value contagion. And one of the ways in which they did that was saying there should be a short stay of up to 48 hours, say the key attributes. It probably has to be at least 5 times as long in order to be realistic in relation to globally systemic institutions, which have very large portfolios. What you need to do is to be able, extra contractually, it doesn't really matter what the parties say, this is a matter of public interest, given the potential for systemic crisis, for there to be a mechanism by which the disapplication of closeout netting clauses in one jurisdiction automatically or nearly automatically can be given effect in other jurisdictions. Now, it's all very nice for ISDA nobly to promulgate the protocol which provides for that, but protocols are contractual. They need parties to sign up. It's also the case that there is inevitably going to be a cross-border tendency towards territorialism by the regulatory authorities of host institutions or related institutions. What you need is a mechanism which empowers other host authorities who want to do the right thing and who know the right thing is to give effect to mechanisms the tools, the resolution tools which have been deployed overseas within their jurisdictions. They should have the power, the legal authority to do so. And the model law would do that. That's how the model law can provide for halt to asset value contagion, information contagion. Information sharing can be made part of the model law. This is what we propose. Ex ante information sharing. We were told that often the key problem would be you don't know who to pick up the phone to when a crisis comes knocking on the door. And one of the things that the model law can do is you know exactly who to pick up the phone to, and you speak to them on a regular basis. You don't have to wait for a crisis for this to happen. So the model law has the potential actually to kick in and provide for mitigation of systemic risk materializing into crisis, or if there is a crisis, mitigating its severity.
Okay, as promised, there's coffee out there, but we're taking only a 5-minute comfort break, and we're going to get back on track so that we know that we end on time today. So please join me again in thanking the entire panel.
It's well, I guess it's not yet it's past the morning. This is our final panel of the day. Just wanted to let you know that there are a number of people who'd like to ask questions or raise matters arising from the previous panels, and we will certainly have time at the end of this panel to enable that. My name is Barbara Romaine. I am a judge of the Court of King's Bench of Alberta, Canada, and one of the authors of this book. The other panel members include Ron Davis, who is a professor, how do you pronounce that, Ron? Emeritus, okay, of the UBC Faculty of Law in Vancouver, Canada, also a co-author. Dr. Stefan Madias, who is another co-author and is a professor of law from Martin Luther University in Germany, is floating on the ocean somewhere near Rome and is going to join us virtually. Finally, we were very sorry to lose as a panelist Professor Stefania Variati of the University of Milan, who had to leave us because of a family bereavement. But we were very, very lucky that Myrta Dyson has volunteered to fill in. Myrta is the legal officer of Unidroit. She's responsible for the project on bank insolvency. Previously, she worked at the Single Resolution Board at the EU Authority. Is that correct? Okay. Just to start us off, this panel is meant to get us into a bit of the nitty-gritty of our model law with respect to safeguards. In sort of gross summary, our model law is based on the concepts of fairness, efficiency, and modified universalism. We have adopted a centralized approach as a default, involving the identification of a home jurisdiction where the resolution scheme will be developed and include all entities in a financial conglomerate at home and abroad. Our model law provides for mechanisms to incentivize the timely sharing of information and cooperation by regulatory authorities. It incorporates duties to cooperate on the appropriate regulatory authorities, and the observation of these duties to cooperate will incentivize, we hope, a facilitated recognition of the resolution scheme throughout the home and all host jurisdictions. Part of that is that sort of assumed recognition could only be refused on particular grounds. And it's those particular grounds that we're going to talk about on this panel. Ron, would you like to start out to tell us why we need safeguards?
Well, thank you very much, Justice Romaine. I'm going to take a leaf from Riz Mokel's book and press my timer.
Okay.
Just so we can we can have a discussion afterwards. And what I'm going to do is try and step very far back and give you sort of an overview of our thinking as to why we came up with the idea of having safeguards as part of a model law. So, as you've probably already heard many times up to now, how does a model law work? But they have a home resolution authority, identifies distress and implements measures, uses measures from the key attributes, etc. And a financial institution has assets, operations outside the home country. So the resolution members require relevant authorities in host countries to recognize and support the measures. And since the measures affect property and rights, other rights in the host country, they must have a legal foundation in the host country. And I think we heard this morning from our speakers from Ghana and Brazil about how people react when they're actually volunteering to do a practice. And they go, oh, no, that's not gonna, you're not gonna touch that thing in my country. So we would propose a model law that would provide a legal foundation once adopted by the affected country. In order to address the anticipated objections to the implementation of such a regime, because people do want to protect their sovereignty, based on sovereignty, we test this provisions against certain criteria in the book. And we believe that this offers persuasive grounds for adoption. The criteria is fairness, and it's both procedural and substantive. Their requirement for timeliness, because of the fact, as you've heard, that the various contagion channels are exacerbated by the passage of time. You must act quickly. Due process, there must be sufficiency amongst the regulatory arrangements to prevent value destruction to the extent possible. Transparency, because everyone has to know what the criteria are for implementation of various resolution tools, and certainty, in order to avoid the feedback loop where people start to get concerned about, they get information, get the wake-up call, and there goes bank run, and as our panelists from Ghana said, they're lining up. It's time to make a decision. So also substantive fairness, and we make this point clearly. In financial distress, substantive fairness involves maximization of value for all claimants through a collective process, as in all insolvency process. But for financial institutions, it's also to minimize the harm from the distress to that financial institution. This is the distinction. From that, to minimize the harm to the financial system, not that institution, because in private businesses, mostly there may be some local knock-on effects, but private businesses, the harm is to them and the people involved in that business. But if systemic crises are allowed to develop, as you know, and we all have the example of the global financial crisis, we're going to have a lot of fun. And it affects Main Street, the economy. So the principles are universal in our view, that is the principle of fairness. Must the law be as written down? We are agnostic about what kind of institutional arrangements are in every country. We think it really doesn't matter. What matters is the ability of the decision makers to obtain available information and make a reasonable decision. That's all we're setting as a goal. And we're, as I said, agnostic as to any particular design or wording of the law. So why add safeguards? I mean, this sounds very perfectly reasonable as it is. The problem is the constraints involved in making these decisions in a timely fashion. The market reaction won't wait and can amplify an institution's distress into a systemic crisis. And I think that the reaction of the US federal agencies to the Signature Bank and Silicon Valley Bank failures illustrates this, because they did not, and they were not considered systemically important banks. But the weekend when they failed, they suddenly discovered they were. And so they took away the deposit limits, the limits on recovery for depositors, to stop the bank runs on all of the same size banks that they could foresee coming in the US, because they had started just as the weekend came along. There are information limitations, as you heard, even with resolution planning, unexpected events could undermine the resolution plan's foundation. The potential information required is fragmented across different jurisdictions. And as we heard, there's very difficult decisions that have to be made about asset valuation. And information contagion and asset value contagion can make this a crazy exercise in trying to figure out what's it worth in the market when the market is starting to panic. And there's varying levels of expertise amongst the decision makers. And the big problem, of course, behind all this is the question of trust. Trust in the home and host regulators for each other. They both have legitimate concerns about the financial stability and the effects of other countries' decisions on that, and that the other country may not appreciate the effect of a use of a particular tool on their financial stability. So also, behind this trust is the fact that there are influences on the resolution authorities as regulators, not courts. There's market expectations of certain outcomes, which may drive public pressure and political concerns to lead to ring fencing and discrimination on national identity by these regulators. So all of these constraints can lead to a less than perfect initial decision. Our position is that a reasonable decision made by a competent authority on the available information should qualify for recognition and support despite its flaws, legal and factual. The safeguards we have identify those limited circumstances where refusal could be justified under the proposed model law. And they're very, very limited circumstances. As will be discussed, any imperfection outside the safeguards can be dealt with ex post and will not impede the implementation of the decision. The core goal is preserving and restoring financial stability and it's done in the public interest, not in the interest of particular individuals or groups involved in the particular institution. I think I made my time.
Thank you. You did. So,
I have 1 minute and 22 seconds left.
so Isabel, can you bring up our friend Stefan? Can you bring up our friend Stefan to talk about the nature of the safeguards that we're recommending in our model law?
Hi, I hope you can hear me now.
Yes, we can.
Excellent. Yeah, I'm very sorry not to be in the room this week already, and now on this wonderful occasion, commemorating Alberto, of course, who I got to know as a very dear friend and excellent researcher, and he was inspiring in so many ways that it's difficult to describe. So I'm really, really sorry not to be with you, but it wasn't possible for many reasons, not the worst ones this time. So let me quickly connect to what Ron just said and explain, basically. So there are maybe 3 levels that should be considered or should be kept in mind when discussing our proposed model law or envisioned model law. The first is that, of course, based on the potential flaws that Ron just described, one could easily say, well, this is a risk for the national regulator don't let this spread across borders, everyone by himself. We think that's the wrong approach. We think there's a good basis of justification for the opposite, for universalism, and for the idea that even though there is no perfect decision-making by the home regulator, by the home resolution authority, it is good enough, it can be good enough for facilitated recognition abroad where it's needed. We think that this is possible for a number of reasons, which are very special to the bank regulators system already in place. But at the same time, this is also homework for the home jurisdiction, because we want them to be as reasonable and as informed in their decision-making as possible. And that's the second layer. The proposed model law, the envisioned model law, would provide a mechanism by which, I explain in a second, early communication cooperation, as it was described by Ms. Sampaio, or even from the African experience, where cooperation is incentivized, and then cooperation benefits from even more automatic cross-border effects. That's the basic idea. So we provide for rule when there is no such thing in place like early communication cooperation, but we envision a rule where once you do that as a home jurisdiction, and then it's easier to get your decision recognized and supported across a border. The third is when you discuss safeguards that may provide a ground for refusal, you immediately get across the term of public policy, because public policy is the one big thing in the rule. This is a traditional approach in private and public international law. So your public policy concerns are the limiting things that would enable you and justify refusing whatever someone else in a different jurisdiction does. We try to dissect the concerns and identify the concerns that may actually, in our view, justify such a refusal of recognition, which always means in a bank resolution that things will not work the way they're meant to be, that there is a possible obstacle that may even frustrate the whole envisioned bank resolution, because key aspects in foreign jurisdictions cannot be brought into place as they should be. So there is a larger public interest also from the home jurisdiction, maybe from a global perspective, in order to condemn a crisis. So there is justification to look into this, and then to identify the things that might actually remain to justify public policy concerns. I'm not sure that you see my first slide, because I don't. But if you see, that's perfectly fine. No need. So if you give me a nod to see my, yeah, this one. So this is basically what we envision. So you see on the left side the home jurisdiction, on the right side the host jurisdiction, the potential host jurisdiction. In the middle there is basically the border, and you see there is a feedback loop. This is why it's a circle. We started top left, the description of what the home jurisdiction should do in order to have a reasonable and timely resolution decision, and then you see already that there is ideally some form of early cooperation communication. On the host jurisdiction side, then once a resolution decision is made that requires cross-border effectiveness, you see that in principle we want this recognition to be universal. That means automatic, as good and as quickly as it can be. So we list specific grounds for refusal that need to be identified in a host jurisdiction by the stakeholders in a host jurisdiction in order to refuse recognition. And these are very limited. It's 3, and you can see them, you can read them. It's a substantive financial stability concern in the host jurisdiction that was overlooked or not even considered when the home jurisdiction made the resolution decision. It's a manifest discrimination against domestic shareholders collectively. This brings me back to the Icelandic case, where the Icelandic home authorities basically rescued their home depositors to the detriment of all other depositors. So something like that would, of course, for instance, in England or Norway or wherever someone was affected and asked for recognition, that would, justify a ground for refusal. And the last one is a sham supervision structure, which relates to the fact that we need to have a fundamental trust in what the home jurisdiction does. While it might not be perfect, it should at least meet fundamental requirements. And if that's not given, of course, there's no basis for trust and recognition can be refused. What it will not be, and that's especially a contrast to corporate insolvency cross-border cases, recognition should not be refused based on objections of individual stakeholders. And that includes an objection that they are worse off than they would be without the resolution measure or with a different resolution measure. So this is probably the most important thing that differentiates this regime from the regimes we know in corporate insolvency. And the second thing as well, in many cross-border insolvency regimes in corporate insolvency law, recognition would depend on a double check of COMI or jurisdiction, or it would give respect to some aspects of applicable law. The famous rule in Gibbs in common law countries does that, for instance. We say that these grounds, while they are maybe grounds for concerns, they are not grounds for the refusal of recognition of resolution measures. In total, this means that recognition is already the regular case in our view, unless quite substantive concerns can be demonstrated and appear in a case. Upon recognition, so bottom right corner, upon recognition, we have support measures. So ideally, the resolution decision and resolution measures will be implemented in the host jurisdiction as designed in the resolution scheme. And then again, bottom left, the cooperation incentive appears. So an early involvement of relevant host authorities would even facilitate what I just described. And this brings us back to the first place, to the top left corner. So if you have a memorandum of understanding with relevant host authorities or even a college of regulators, and they agree on a specific resolution path and resolution decision and measures, which also already is informed by what is happening in a host jurisdiction and is agreed to by the relevant authorities in the host jurisdiction, then top right again, we have presumptive recognition even. So because, we have already someone of the relevant host jurisdiction participating in the decision-making in the home jurisdiction, we think that in these cases, recognition can be almost automatic unless something new appears. So this is, again, an incentive for the home jurisdiction to engage in early communication and early cooperation, because it can actually facilitate later recognition of selected measures in relevant host jurisdictions. Okay, this is the first part. And then my second slide is on what do we do with individual stakeholders and their concerns? What do we do with concerns on jurisdiction, applicable law, etc.? In a traditional private international law, especially setting, these would be concerns that might become relevant on the recognition stage already. So if you have a restructuring plan, for instance, and you have a creditor being worse off under the plan than without a plan, this could justify public policy concern in a relevant jurisdiction. We think this is not what should happen in a bank resolution, because individual stakeholders have a different position in a bank resolution than they have in a corporate insolvency. They do not get to vote on a plan. They do not get involved in the decision-making process. They're investors, they're money investors usually, so they should be protected by their monetary interest, in brackets only. So what we have identified, for instance, in the Canadian example, is the ability to implement a compensation scheme instead of a ground for refusal. And this is what you see on this slide. Just quickly, 2 minutes, and then I'm good. This compensation scheme would reflect the individual concerns of stakeholders of them being worse off under the valuation being done, the initial valuation or later valuation, a concern on jurisdiction of the home jurisdiction in the first place, a concern on the applied resolution laws. These kind of individual concerns, individual objections would be reflected in a compensation scheme. So if proven ex post that the valuation was off, many jurisdictions provide for an ex post valuation already under their insolvency, under their resolution schemes. If the valuation comes up with a better value than initially thought, compensation is due. This compensation should be due for all affected stakeholders, those at home as abroad, which then would reflect a common compensation scheme that would be handled in the home jurisdiction, would need to be handled in the home jurisdiction. If it is handled in the home jurisdiction, you wouldn't need a ground for refusal, and every affected stakeholder, often they are professional stakeholders, sophisticated stakeholders, would need to file a compensation claim and prove the concerns that they have in the home jurisdiction. It wouldn't affect anything in the host jurisdiction. If, however, the home jurisdiction, or until the home jurisdiction has provided for such a resolution scheme, compensation scheme, of course, stakeholders must be protected as well. So we would still think this is not a basis for a ground for refusal, but the compensation could then be litigated under common choice of law clauses in financial instruments in the jurisdiction identified under the choice of court clauses and the choice of law clauses in the financial instruments. This would certainly decentralize compensation claims, and again, it would give an incentive to anyone to every jurisdiction to implement our model law and provide for a compensation scheme at home, which again would then bar any jurisdiction for such litigation abroad. These was my 10 minutes. Thank you.
This gives us an opportunity to say that these slides that have been carefully prepared by Stefan are in our book at pages 381 and 382. I thought that it was very kind of Professor Hannah to put our book up on the screen. So I'll just remind again everybody that this is what it looks like. Okay. We'll now go to you, Myrta, to talk about how this might be the same or different from the EU principles.
Yes, thank you very much. And first of all, thank you very much for the invitation to join you here today. It's really an honor to join this panel. Indeed, I will look at how actually the EU cross-border resolution framework works. So we've heard this morning about experiences in Brazil, in Ghana. So we thought it would be nice to kind of complete the picture by also giving some insights in the European perspective. I do this on a personal basis. I have not been involved in the book at all. I must confess that I haven't even read it yet, but and I'm not here as representing UNIDROIT as a legal officer for the Bank Insolvency Project, which is a separate project that we have. So when we talk about the EU cooperation agreements and more generally the cross-border framework for resolution, of course, first of all, the EU authorities cooperate in the international established groups. So we've heard this morning already about the FSB key attributes. So there's FSB key attributes 7, 8, and 9 that, among others, provide the need to establish crisis management groups for globally important financial institutions with the objective of enhancing crisis preparedness and exchanging information for such largest banks. So the EU authorities participate in those groups, but of course only for the GSIBs, only for the largest banks. And these cooperation platforms
are underpinned by COACs that we heard about this morning as well. So multilateral institution-specific cooperation agreements, and the EU authorities are part of those as well for the crisis management groups they participate in. So that's from the international level. Now moving to the EU-specific framework. We've heard this morning about Ghana and Africa, 54 countries, that's a lot. In the EU, we're lucky to have less, so we only have 27 European member states. And we actually have one underlying framework in place for bank recovery and resolution. That's a directive, a European directive, the BRRD, that provides for minimum harmonization. And I would like to recall what Edith said this morning and also Ignacio about the need for substantive harmonization of the rules actually for how to deal with banks and how that can help already to cooperate cross borders, because if the rules are more alike cross borders, it's less likely to have conflicts about them. So in the EU, we have this. There's minimum harmonization through a directive. On top of that, for the banking union, so those are the 20 Eurozone countries, but also additional countries can join if they want to participate in the banking union, which, for example, Bulgaria did already. So for this subset of countries within the 27 European Union member states, there is a specific framework that goes a bit further because there's a regulation for resolution and recovery and resolution of banks. And apart from that, it goes a bit further already because it is a regulation and not a directive. The most important element in my perspective is that it provides for institutional harmonization in the sense that there is centralized decision making. And I will get back to that in a bit. So we can go to the next slide. Yes, before turning to, because I will be speaking about resolution colleges and their functioning, before doing that, I wanted to just recall the general principles on cross-border resolution within the EU that are laid down in this directive I was mentioning before. You will see them here on the slides. There are 12 of them in total. And these general principles are supposed to guide the authorities when they have a cross-border scenario. I think an important one is that due consideration needs to be given to the interest of other member states. So if there is a banking group that has entities in different member states, you need to take into consideration the impact that any decision may have on the financial stability, but also the fiscal resources, the use of the resolution financing arrangements, and the deposit guarantee scheme in other member states. And another important one that I wanted to highlight is the nearly final bullet point. In principle, follow the resolution plan. This is what the BRD says. And why does the BRD say this? That's actually very much in line with what other people said before, that if you already prepare from the beginning together and cooperate in what you would like to do in case there is a crisis, then of course that helps when you reach the point where a bank is actually failing. So this resolution plan is, in case of groups with cross-border entities, is already drawn up in a resolution college, which I will explain now. And that then, of course, helps at the point that a bank is actually failing or a banking group, because you have already agreed in principle on a resolution plan together. That should be taken as the basis, and then you would need to explain in case you feel the need to deviate from that plan at the moment of non-viability. We can go to the next slide, please. So what are these resolution colleges? Well, they're kind of similar to the CMGs at the international level. There's two types. There's resolution colleges and European resolution colleges, which is always a bit of a weird distinction in terms of name, but resolution colleges are for banks that are headquartered in the European Union and have one or more subsidiaries or branches in other member states. Whereas European resolution colleges, the parent is located outside the EU, but there is presence through subsidiaries and branches inside the EU. So that's the difference between the two. The participants you will see here on the slide, it's quite similar to what the CMGs also say. So there is the group level resolution authority. This is where there is the consolidated supervision. The resolution authorities of subsidiaries and significant branches, the supervisor as well, competent ministries, authorities responsible for the DGS, so for the deposit guarantee schemes,
And there is the European Banking Authority as well as a non-voting member, which has a role also in non-binding mediation in case there is a disagreement within the resolution college. Now you will ask, what about foreign third country authorities? So those that are not within the EU, because a banking group may have different entities within the EU, but probably also outside. Well, those authorities can participate in resolution colleges as observers. They need to request to do so. But if there is a subsidiary or a significant branch in those third countries, so outside the EU, they can participate in the resolution college as well. There's only one important requirement, that they need to be subject to the same or equivalent confidentiality requirements. And that seems something very minor, but that in practice means that there needs to be done really an assessment of the confidentiality requirements under foreign law, which entails a lot, also data protection and everything. So it's not so easy, but it is possible. Then you will see on the slide on the right-hand side, the yellow box, how this is arranged within the banking union. Because within the banking union, actually the SRB acts as the group level resolution authority for the banks that are under its direct remit. And then the national resolution authorities, they can still observe that resolution college for that same bank, and they can be a member of the resolution college for the banks that are under their direct remit. That's in principle what it says here. Next slide, please. So how does this work? I will not go into the details of all these 4 steps, but these are the 4 steps that need to be taken in case of a resolution action involving a group with several entities across the EU. So first there's the decision, do we need a group resolution scheme? The second step is, what will this group resolution scheme entail? So what are we going to do? And then there's a need to coordinate the use of financing arrangements, so the use of the resolution funds and coordination of public communication. Next slide, please. So to decide on the need for a group resolution scheme, this starts when there is actually an entity that is failing or likely to fail, like we say in the EU. So when an entity is non-viable and there are no alternative measures that will prevent the failure within a reasonable time frame. This can happen with a subsidiary or with a parent company. This resolution authority then needs to notify the resolution college of this, and there needs to be first a dialogue within the resolution college about this notification, and then an assessment needs to be made, that is being made by the group level resolution authority, to see whether the fact that a specific entity meets the conditions for resolution would also make it likely that other entities within the group would also meet the conditions for resolution. And if that is the case, that is then a reason to adopt a group resolution scheme instead of a single individual scheme. And you see on the slide that in case not a subsidiary, but a parent is the one that is failing or likely to fail, there may be other reasons to adopt a group resolution scheme. So not only in case it affects the other subsidiaries, but also if action at the parent level only would not be sufficient to stabilize the situation for the group as a whole. So that's the draft assessment. And there's a consultation round with the members of the resolution college. They can express material divergent views if they don't agree with the fact that there is a need for a group resolution scheme. And then in the end, it's for the group level resolution authority to propose a group resolution scheme if that is the outcome of the assessment. Next slide, please. So this is then the joint decision process on the adoption of the group resolution scheme. You see here in the blue boxes. So there's a draft scheme, consultation, preparation of a joint decision on the adoption of a resolution scheme, group resolution scheme, finalization, and then communication of the outcome to the members. I think what is probably most interesting for us is to see what happens if somebody doesn't agree with the group resolution scheme. Or considers that it needs to take independent action for reasons of financial stability, because this is possible. Well, what happens then is that this resolution authority that doesn't agree needs to provide detailed reasoning why it doesn't agree with the group resolution scheme that has been proposed. It needs to consider the group resolution plan, which had already been agreed. So if the group resolution scheme is in line with the plan, then of course more reasoning is needed to explain why you now all of a sudden don't agree with the group resolution scheme. But it also needs to provide reasoning on the potential impact on financial stability in other member states if it decides to take independent action. If one of the authorities doesn't agree, still the others can together adopt a joint decision for the group entities that do agree. So then there will be two different decisions. And importantly, then each decision, whether it's a joint decision or not, needs to be recognized as conclusive and needs to be applied by the resolution authorities within the European Union. And then the last point was just if there is no group resolution scheme implemented, still the legislation says that there needs to be close cooperation to ensure that there is a coordinated strategy. So that is the process that we have within the EU. I think we can go to the next slides, please. I already mentioned the European Resolution College. So the main difference is that in this case, the parent bank is headquartered outside the EU, but you would still have a European platform for discussing about the entities that are located within the EU. What I wanted to highlight here is actually what happens in case there's a third country, so a country outside the European Union that wants to take resolution action, and then the decision needs to be made whether to recognize and enforce this within the European Union. And this is arranged in Article 95 of the BRRD, where you see the grounds for refusal of recognition or enforcement. And I think that's looking at or hearing what Professor Madaus said previously, I think some of them are maybe quite close to what is also in the book. This is my impression. An important one ground for refusal of recognition is if EU creditors would be discriminated. So if they would be would not receive the same treatment as depositors would receive in the home jurisdiction. So this is something that I think was also on the other slides. Financial stability was also mentioned in the book and also is a ground for refusal under the EU framework. So that is the same as well. So I think that is actually quite aligned with this general principle of fairness, and which was mentioned before. Within the single resolution mechanism, so within the banking union, the process is a little bit different in the sense that since there is a centralized resolution authority, the SRB will issue a recommendation to a national resolution authority on whether they should recognize and enforce a foreign, so non-EU resolution proceeding or not. So because there is this centralized idea, then after the SRB's recommendation, a national authority may still decide to proceed differently, but it's a comply or explain principle. So they would need to provide reasons why they don't follow the SRB's recommendation on recognition or enforcement. So this was my small contribution. I hope it was useful, especially for the people that are not familiar with the European framework. And many thanks again for this opportunity. I'm happy to answer any questions, of course.
Marta, you referenced the fact that that Stefan mentioned that the public policy considerations that would allow a host company to refuse recognition under our model law are limited, arguably more limited than under other current considerations, including, I believe, the EU. We understand that that might lead to some questioning and some controversy. So, I just wanted to point out a couple and see if you wanted to comment on them. One is that let's see, we believe that if there is a dispute, a valuation dispute, that any valuation dispute would not be able to head off recognition, but would only be dealt with in the compensation part of the 8x after the matter has been resolved. That's one. And another area that I understand may be different from the EU is that we recommend that a possible breach of the adequate protection or no creditor worst off safeguard would not be a circumstance that would lead to the possibility of non-recognition. And instead that as well would be a case for compensation. Do you want to comment on that?
Yeah, so well, in the article in the BRD that deals with this recognition of non-EU resolution proceedings, there's no mention of the valuation, so it's not specifically addressed, which you can interpret also as as that it's not a ground for refusal, because in principle the grounds for refusal are outlined there. But of course, I think what is an important difference between what you propose, which is what I understand an exhaustive list of grounds for refusal, and the BRD, is that in the BRD, the last possible ground for refusal is that if the effect of recognition and enforcement would be contrary to national law. And that is, I think, what is the more broader ground that can, of course, still be interpreted in different ways. And then we come back to the public policy.
Well, and of course, public policy is a term that sort of raises red flags anytime it's mentioned to a judge. Some 19th century English judge said something about public policy is an unruly horse. So, you know, that, you know, once you get on it, you'll never know where, where it'll go. And that certainly struck me as being apt, both in my equestrian event efforts and also in my legal efforts. So, yeah. The point, I believe, under the model law is that we try to be very explicit about what public policy concerns would enable a refusal of recognition. So I think that given the time, we'd like to open the panel to questions on not just to this panel, but to any of the previous panels. Questions, comments, or discussion. Yes, Louise. Okay. Oh,
it's not really for this panel. I mean, it's for, well, all 8 authors of the book, or however many, how many are here. Because you and Irit talked about this, where you're talking about a model law, and I can absolutely see why you might want to go for a model law, because if you go for hard law, then that's going to reduce probably quite dramatically the number of states that may engage with this, and it'll take a long time, and it's not just going to achieve what you want. But it seems to me that this model, I mean, maybe I just got this wrong, but with a model law, to do what you want it to do, particularly if it's a model law on private international law, basically it needs to be enacted in pretty much the same form in every single jurisdiction. So what you've got, as I understand it, and I may have got this wrong, you've got a mixture of private international law rules and some substantive law rules in this particular model law. And so, and given the concerns, as it were, about sovereignty and so on and so forth, so sort of 2 questions. I mean, how likely do you think it is that every state will enact it in this exactly the same form if it came about? And secondly, what incentives do you think there are for states to do that, or have you considered that as to what the incentives are for states to enact it in pretty much the same form? In other words, treat it like a treaty text, even though it's a model law.
First of all, thanks, Louise, and Louise, you got it really right. So that is exactly the intention, that it will be an instrument which is softer than a treaty, so that it is more feasible, but still hard enough so that it can create that kind of framework that you are envisaging as well, recognizing that at least with regard to the private international aspects, we need something which is enacted more or less in the same way in all the countries. Now, you also mentioned that we are envisaging some kind of hybrid or composite type of instrument that will also include some substantive laws, some tools. And here we make a difference, and we didn't really mention it fully in the presentation, but we explain it in the book, that we see that part, that section in the future model law is more modular than the rest. So private international law rules should be enacted, encouraging countries to enact them more or less as it is. But the section on the tools is more modular, recognizing also what Vivian was saying about the need to integrate it within the contextual framework locally. Now, still feasibility is a big question, even if we do that kind of distinction. And even if we just focus on the private international law issues, we've seen with previous experience also in the context of business model laws that there are still gaps and difficulties in agreeing on the more difficult issues. And perhaps the most difficult one is the applicable law rules. And we are now in the process of dealing with that in UNCITRAL regarding the business context. And I think we are managing. It is difficult, but to answer your question, I think it is feasible. And we did think of incentives. I think Chris will perhaps elaborate on that. But anyway, we did think of incentives. The incentive is sort of inherent to the model law in the sense that we are saying to countries, well, if you adopt that, including potentially the tools themselves, then it is more likely that both your authorities, your host authorities will be able to quickly recognize something that is happening abroad and vice versa. If you're the home country, you will be recognized swiftly, and all that will create a system that is more effective, more fair, not discriminating stakeholders in your jurisdiction as well. So it does require a negotiation process, which never is easy, but because we are envisaging a model that is based on modified universalism rather than some kind of so-called ideal, I don't think it is ideal, pure universalism. So something which is realistic, but also ideal in the sense that it is optimal for the circumstances of different financial institutions and countries. I think it is possible to achieve it.
I think the other point I would say, Louise, is we were really careful not to advocate a model law in the sense of we are proposing a framework for the development of a model law. And that's because for a model law to be truly adopted requires a process through UNIDROIT, through UNCITRAL. And so it's really a call to do that and to say these are our best views on what should be debated and what should be decided. And that's part of the modular approach. But it's because of those processes that the model law on cross-border insolvency has had uptake in 60 countries. And it's because of that that the adoption has been not no changes, but really minimal. In most jurisdictions, I would say less than 1 or 2% change. And even where there's been 1 or 2% change, what we've noticed, although nobody's done an empirical study to my knowledge, is that the convergence of the case law happens very quickly. I'll give you one tiny example out of Canada. We chose under the model law on cross-border insolvency when we enacted it to not use the word manifestly when something's manifestly contrary to public policy. The reality is, as soon as this cases started coming, the court said we're going to interpret that extremely narrowly because the importance of comity and cooperation was paramount. And so that's what we've seen. And if we had a process globally through one of our established, bodies, and you built that consensus, then the likelihood of adoption is very high, and the likelihood of then adopting and recognizing. I think the last thing I'd say is I would love someone to do an empirical study, because what we see in the cross-border cases on the business side is that the first sort of 5 days of litigation are gone now, right? So that if there's a foreign main proceeding, the court recognizes it such, and all of these other relief measures happen immediately. And then parties are squabbling perhaps about the plan of restructuring or of the outcome. But we have taken away a huge amount, we meaning UNCITRAL and all the countries involved, have taken away a huge amount of litigation, which I think is something people forget sometimes. But in fact, those kinds of debates that happen, litigation, court cases, et cetera, are now gone because of the high acceptance and adoption. And if we could have the same for bank resolution, financial institution resolution, it would be amazing.
Both Edith and Janice have hinted at this, but don't let perfect be the enemy of the good. And there is so much scope for doing good in this area that even if there is a real risk, and I agree that there is, that adoption of any model law would not be done perfectly and that there would be some deviations, I can't help but think that it would still be so much of an improvement in vast areas of the world where there is no cooperation at all, where the relevant authorities want to do the right thing, the thing which enhances and preserves value and treats all of the stakeholders, including domestic ones, fairly. But they simply lack the legal authority to do that, and therefore it becomes a political discretionary decision. And sometimes those decisions turn out to be exactly the right ones. Often they don't. So having a framework based on the rule of law, even if it wasn't perfect, would be so much of an improvement.
Are there any other questions or comments? Lady here.
Thank you. Claire Merrifield from the Bank of England. First of all, thank you to all the speakers for a really fascinating morning. It's been a great session. I have a question for the book authors. I'm interested in the grounds for refusal of recognition and the fact that you don't have a ground based on the action being contrary to public law, and how that fits with the overall concept of applying modified universalism. I'm sure it's probably possible to give a whole talk on this, but if the authors would be able to say a brief word about how the two interact, that would be fascinating. Yeah. Thank you.
Ron, are you going to? I'll start. Yep.
So this may seem backwards, but if you think about what we're proposing that the model law be adopted into national law. So if it is adopted, then it wouldn't be, contrary to public law to recognize and support some other jurisdiction's decision about resolving its bank or financial institution. That's very, I know that's very simplistic start, but that's sort of where I started from going.
Yes, I will just add to that. Yeah, I would just add to that and say, so the main safeguard is a public policy safeguard that you enact into your system once you enact the model law. And essentially that public policy safeguard is based on concerns concerning some manifest concerns regarding financial stability or situation of discrimination. And then there is the additional protection which Barb explained regarding compensation mechanism, where so the no credit or worse off that we are envisaging in the model law is a no credit or worse off cross-border wise, namely the fact that we centralize the process in another jurisdiction. If it affected you, we do take it into account in the initial stage in terms of the law that we apply. So the applicable law rule, it's a little bit difficult to explain all that in a few seconds, but the applicable law rule in the home country takes into account the fact that we have a creditor subject to the subsidiary law. So that will be taken into account so that they are not worse off by this centralization, by this difference. So it is already taken into account. You don't need a safeguard for that. However, there is an additional safeguard. If that did happen, if eventually through evaluation we realize that centralization was affecting negatively certain creditors, we deal with that on at the compensation level. It's not a reason to not recognize, not support the whole process. So the whole process still need to be supported. What Ron was saying is also more directly responding to your point about what Mirta was saying is available under the BRRD, so that to say, well, if it doesn't fit with national law, so that is very general and that is very problematic and in a way not really needed once you have the model law. The model law becomes your law. That's your national law, right? So your national law, part of your national law also includes the private international law of resolution. And in that private international law of resolution, you have those rules regarding jurisdiction, applicable law, recognition, and the safeguards. So it's all part of the national law. And so if we refer back to national law, we are being circular in a way, if you see what I mean.
am I correct to think that what you're saying is if the UK passes the model law and then Ruritania opens a resolution process and requests a recognition of resolution action in the UK, and that particular action is contrary to the law of the UK, then what would, is that was that your concern was?
Thank you. I think that kind of exception that we have similarly to the BRRD might not be required if all resolution and bank insolvency regimes were consistent. However, in an imperfect world, my personal view is that I think that that exception perhaps should be limited, but is not without merit. So that's why I was interested to see that it wasn't in the recommendation. But
what I mean to say is just the fact that we don't have in UK law that particular measure that is being applied in the home country is not a reason to invoke the safeguards. And that is in line also with the key attributes, right? Because we need to find an equivalent measure locally. So that isn't a reason. We are not envisaging full harmonization. The whole idea of having a private international framework is to deal with situations where there is divergence. So it needs to fall below that fairness threshold that we are also adopting within that envisaged model. So if it's below that, right, it doesn't comply with what we mean by pari passu principle and etc. So some basic standards, then you may say, well, that is against public policy because that measure, we cannot really accept that even through some equivalent tool that we have locally.
If I could just add one more thing there, we didn't have time to go through all of the safeguards, but one, if the supervision structure in the home authority can be construed a sham, then that allows a refusal of recognition. I know we're not talking about, a sham is hopefully a very rare experience, but also if there are allegations of breach of duty of fairness or due process or non-discrimination with respect to individual shareholders or stakeholders, that would not justify non-recognition, but it would be a question for compensation. So I don't know if those two things help a little bit in terms of your question. Okay, I think we have time for one more question, and somebody had his hand. Yes, sir.
Calvin is saying University of Warwick. It's a fascinating event, and I congratulate the organisers for it. And I learned a lot from this private law perspective. I guess in some respects, we have got some now modified universalism through the crisis management groups, where decisions have, in some respects, been formalized within a administrative arrangement. Whether those decisions are then actually executed is another matter. So, in my view, from a public perspective, public bank regulation perspective, there may be some form of modified universalism. The other element is actually another case. For example, if we look at Sberbank, how that decision was taken within the either single resolution board, it's an excellent example of how a decision was made within the banking union, how it was recognized within the European Union, and indeed recognized outside by third countries. So there is perhaps some practice of recognition in bank supervision and resolution, in my view. So I don't really have an question, more of an observation about this form of modified universalism that we perhaps take for granted. Thank you.
the problem with crisis management groups, and especially with the coacs that are giving some substance to the crisis management group, is first of all, it only refers to certain really large groups, and second, it's still soft in the sense that you do have some expectation of collaboration, but I mean the very few we've been able to see, always leave a big open door for no implementation of resolution measures. So it's in that sense, that's why the model law would be a little bit more binding without being completely, depriving the state of its sovereignty. So it's modifier universalism maybe if the authorities decide to implement it, but if not, but the points, of course, will take.
Thank you. Thank you. I think that's all the time we have. And I'd like to turn it over to Lord Richards.
Oh, please.
Prova. Prova. Yes.
I'm not going to detain you for long at all. I have found this an absolutely fascinating morning, as I did reading some, I'm afraid not all, of the book, but I have, for the sake of full disclosure, read chapters 1, 2, and 9, thanks in part to Riz's advice as to what I should direct myself to, but I'm looking forward to reading the rest of it. It's a good moment just to mention the book, incidentally. It's a remarkable work, I think. It took me a few pages to get my mind into the right place to sort of really get a grip of the book. But it didn't take very long. And once I was there, I found it really interesting. It's deeply thought through. And it's absolutely remarkable that it is the combined work of 6, 7, 8 authors. And we do have a description in the prologue as to how that was achieved, and very considerably thanks to Janice, I think. Anyway, I do recommend it. It's very thought-provoking. It's also extremely informative. I mean, in the sense of giving you the background to what we're talking about here, both historically and geographically and financially and so on. There is an absolute mine of just information available in it. Now, it prompts a huge number of thoughts and issues and problems, some of which have been addressed today. I've decided I'm not going to comment at all on the substantive issues, partly because I'd be repeating myself, and partly because it would be displaying a degree of ignorance of those issues, which might be unfortunate. But there's no point in sort of even trying to summarize what has been said today. But what I think I have, and I perhaps echoing what I said at the end of the first panel, it's in part the range of views and experiences that we have heard today, which has been so valuable from different parts of the world, knowledge of different systems, both financial and legal. And that underlines, I think, underscores the real value of a session like this. It's a shame in one sense that we're not all in the same room, just some of us are, but there's a large online participation as well. And it really does demonstrate the importance of this sort of meeting, I think, where we hear the views, because actually it becomes easier to read the book, the literature, once you've heard it explained and discussed orally. So I think it's been a morning of really huge value to me personally, and I hope and believe to everyone else as well. I've been interested by the discussion at the end about the bases on which a host country might decline to recognize the measures proposed by the home jurisdiction, and I'm largely satisfied by the way that's being approached. There's always a slight underlying issue, which perhaps as a judge I'm slightly conscious of, which is the point that you can't really, it's difficult to express, but it's trust in the integrity of those who are operating the systems to be recognized, trust in the integrity of the regulators and of the courts. And that's a difficult subject to grapple with, because it can have a wide spectrum from a system which is utterly corrupt, and they do exist, and those to which there are rather lesser concerns. I think the concerns at the lesser end are largely met by the proposals for compensation and so on, and the duties that the host jurisdiction must follow before introducing measures. But that's a point we have to bear in mind. I'm not quite beyond a sort of public policy and exclusion. It's not quite clear how one best deals with it. But these are real problems. I mean, they come up for courts when deciding, for example, whether to stay. I mean, not in an insolvency context, but just in ordinary litigation. You have a claim between A and B brought in your court, but a similar claim has been, or a reverse claim has been brought in a foreign court. And the question arises as to whether to stay the claim in your court to allow the proceeding in the other court to proceed. And the integrity of the court system in that other country is an issue which can arise. It's a very difficult and uncomfortable issue to grapple with, but courts have to grapple with it. So there is that issue which we can't forget, but you can only deal with it through some general language, which you then leave to the good sense of the authorities and courts in the relevant jurisdictions to apply. Just on the point of courts, Professor Kanda made the very good point that that regulators and authorities act sort of proactively and the courts act passively, and courts necessarily perhaps are slower than regulators. I mean, to an extent, well, to a very considerable extent, that is true. It's certainly true they act passively rather than proactively. In the early stages of proceedings, courts are involved very, very quickly. So if one looks to see, just take Lehman's, but it's simply an example of the involvement of the courts at a very early stage, they are reacting very swiftly. But I entirely take, and I strongly endorse the point that Janice made, that one of the many great advantages of the existing model law, the 1997 model law, is that it actually cuts out several days of court proceedings. And I think that is a really important practical result that may not particularly have been in the minds of the framers of the model law. It may have been, but it is a very real advantage. The other point, though, that I mean, I'm in an appeal court, and we tend to get cases which, this isn't always the case, but it's normally the case, about things which occurred several years ago. I mean, 2 Lehman's cases went to the Supreme Court in the UK, one in 2012 and the other in about 2016. So they were both about 3 years behind the issue. And that's just the way of appeals, really. So I find myself in the position of, generally speaking, looking back. But what is so cheering here are you looking forward. So the work that you've all been engaged in, and the work that the authors of the book have been engaged in, lawyers, central bankers, and so on together, is looking forward. And when I just asked the president of my court whether it would be okay if I came today, apart from the fact I wasn't actually listed for yesterday or today, he was very positive in his view that this was absolutely the right thing for me to attend, and I'm grateful to that. Things have changed. We've had the model law, 60 countries or so have signed up to it. It really shows the way that, it was quite a leap into the dark, I think, for many of the countries which adopted the model law. But I doubt if any of them regret it. It's worked well in practice. It really has. And so there's no sort of precedent reason why a model law for banks and similar institutions shouldn't work well as well. And I think one can gain a degree of confidence out of that. Things have moved a lot since 1997 or thereabouts. If one looks back over the last 25 or 30 years, it's quite remarkable the things that we all take for granted now, which were revolutionary, absolutely revolutionary at that stage. Before my final word, can I just note, if I may, I hope this isn't inappropriate, another change which I just happened to notice when I was chairing the first panel and looked around the room, and I counted, I think, 40 participants in the room today, of whom 25 are female and 15 are male. That would have been absolutely impossible 25 or 30 years ago. Not only would the proportions have been the other way round, but they would have been very distinctly the other way round. And that too, if I may say so, is an important development and change that has occurred in the last 25 years or so. So it leaves me only to thank the organizers of this event, to thank Ignacio and UNIDROIT for all your organization and for hosting it here, to thank Janice for all the work that she has done, not only on the book, but on today's event, to thank all those who appeared on the panel, and finally to thank all those both in the room and online who have joined us today. Thank you all very much.
Thank you. Thank you for that, Lord Richards. Well, I think we could all agree with everything that you said. I should say that a majority of female attendance is not surprising in this institution, which is basically run by women. There are very few of us. So it would have been strange otherwise. Second, I think this was the type of discussion and debate that we are proud to have in this place. Rome is full of churches. There's no other city with as many churches as Rome, but temples, there are not that many. And this is one of the temples of the law, and it has been so for almost 100 years. This library hosts almost approaching 500,000 volumes. It's not so much the quantity. They're under, Rosa. They are not around. They're in the basements. So it's not the number of books. It's the type of books, because many of them you can only find here really because they are the law, the books of the systems of countries, which are, unless you go to that particular country, you will never find any legislation about. So it's a comparative law organization, and in that sense, it's this has been the temple, and where the discussions on the most technical and difficult parts of private law have taken place for decades. So it was very fitting. I thank all of you very much for that. Also, you were spot on when identifying Janice as the person who led all of us, not only in the second book, but also in the first book. And the people, and I'm speaking about the others, not me, everyone is very, they're very highly reputed academics or judges, opinionated too, and with strong opinions. And so leading them is not easy. And Janice has always done it with her grace, and her natural leadership is something we've all, no one's ever questioned from the beginning. It was just this natural leadership that she commands authority. We don't know why, but she does. So you got that absolutely right. And another person who was part of this group and who also commanded a lot of authority and affection, in not doing it by waving any flags or any titles or by way of potestas, but rather by autoritas, is Alberto Mazzoni, which is why I'm taking the floor now. Alberto Mazzoni was our president here at UNIDROIT, but he was many other things. First of all, and I'll be very brief, as a scholar, Alberto was advanced to his time and very modern in many ways. He was one of his kind in the Italian academia, very much oriented towards Germany and also France, perhaps for many, many decades. Alberto had a much more Anglo-Saxon approach to the law, much more functional. Now that's more common, but back then when he was there, that was not so frequent. And I personally think he was right, but others might think, no, we should go back to the texts in Gothic German, but that's a different thing. And so Alberto was very modern in that sense, and he opened a line of scholarship which followed that, and I think it was very important in his own way. Probably had to do with the fact that he was a lawyer in New York for many years as well. So he was a very creative scholar, and that is something which reflected not only in his publications, but also in his legal initiatives, wherever they were. He was especially a hugely important legal reformer. He participated very, very actively in Ancitral in some of its working groups, but he, in a way, led a good part of the Italian delegations going to Ancitral in several of the working groups. So he was the driving force behind many in Ancitral's working groups in a time when Ancitral's instruments, its most signature instruments, were being produced. So I think I can quote freely because she said it publicly. Alberto, when the model law on cross-border insolvency was being discussed and it was in its final stages, there was a moment when it seemed like it was going to fail. And Alberto made a proposal, and with his ability to talk to everyone, he saved the model law. And Catherine Savo, who was already present there, she said, Alberto saved the model law cross-border insolvency. So the model law on cross-border insolvency, in part, is also the creation of Alberto. Alberto, of course, apart from Ancitral and his participation at the World Bank, was our president and therefore very much a UNIDROIT person. He was not just a president, he was someone who shared the tenets and the grounds that lied under the foundation of UNIDROIT in the League of Nations almost 100 years ago. He was a humanist in the how can we say, in the Renaissance type of way, and he tried to apply that to this institution. I was unlucky to only coincide with him, me Secretary General, he as president, for about 10 months, most of which he was sick. So I did not have the possibility to enjoy. Anna did for quite some time, so she was luckier here. But nevertheless, his imprint in this organization is still felt and continued throughout all these years after he's no longer with us. He was an extraordinary human being and a dear, dear friend of all of us. And he made our time in Bowen and everywhere else where we met not only rich in an intellectual sense, but I think a wonderful personal experience for all of us. So with that, I think we'd like to say that this book and this workshop are also his in a way. And so thanks for accompanying us in this meeting, because it means a lot to us, not only professionally, but also personally. And with this, And now there's lunch being offered in the second floor in the other building. Yeah.